This is a cycle where we're unwinding massive COVID distortions.
When we talk to firms, they're still trying to hire. They're still trying to find people.
Our view is that economic momentum is going to be downshifting here over the course of the next year or so.
For the Fed, it's mostly a question of how quickly do they go back to neutral, which would be around 3%, and my guess is not very.
Everyone believes that there's going to be a rate hike in May, but almost no one is talking about beyond May.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Getting your week started with equity futures on the S&P 500, totally unchanged. Here's your headline. We have a deal. And here's the quote from JP Morgan's Jamie Dimon. Our government invited us and others to step up. And we did. JP Morgan winning the bidding to acquire First Republic Bank. Lisa, I make this the 1, 2, 3, fourth. The fourth bank to fail since early March.
And the second biggest one ever in history to fail under FDIC's watch. This raises a number of questions, including, A, is this a bailout? What is the bailout's cost to the FDIC? And could it have been avoided by perhaps intervening earlier or perhaps better regulation on some of the loans that this bank underwrote?
And is it the last? And what does it mean for the Federal Reserve later this week when they meet on Wednesday? Again, another interest rate hike on the table following a bank failure in the United States of America.
Well, the FDIC board member who put out a statement put this actually quite well. And he basically said that this is going to be inevitable, that this is part of a healthy ecosystem in a capitalist society, that there will be bank failures. He said that the only way to really plan for that effectively is to focus on strong capital requirements. Question, does that mean more regulation? And an effective resolution framework as our best hope for eventually ending our country's bailout culture that privatizes gains while socializing losses. What is that framework?
Here's a question. Where's Warren? Where's Berkshire Hathaway? In the FT, maybe we got a little bit of an answer to that from the Berkshire Hathaway Vice Chair, Charlie Munger, speaking to the Financial Times. And here was the lead paragraph, Lisa. Charlie Munger has warned of a brewing storm in the US commercial property market, with American banks, quote, full of what he said were, quote, bad loans as property prices fall.
In other words, did they not take over First Republic? Were they not interested because of the quality of these loans and the losses they might have to incur, especially because they didn't have that banking infrastructure that JP Morgan had to potentially offset that and share those losses effectively with the FDIC?
SVB, idiosyncratic. Signature Bank, idiosyncratic. Silvergate, idiosyncratic. Credit Suisse, idiosyncratic. First Republic, idiosyncratic. How many banks need to fail before it's something broader, bigger than just sitting here and saying every single one that goes under is idiosyncratic?
You've been really good about pointing out the distinction between something that could be a crisis that is in 2008. It might not be a financial system collapse, but this drip, drip, drip leads to more credit tightening, leads to concern about deposit risk, leads to broader concerns that lead to fissures in an economy that depends on the full faith and credit of the U.S. backstop of this banking system.
It's the start of a process we've got to work through, potentially for weeks, months, maybe even quarters and going into next year. Let's start with your equity market and take a deep breath, one step at a time. The equity market right now on the S&P 500, we are totally unchanged. Remember, Europe closed for a bank holiday over in the UK. Looking at the bond market, yields are a little bit higher by 3 basis points on a 10-year, 345.60. In the FX market, bit snoozy there as well, just about holding on to 110. Not just the Fed on Wednesday, but also the ECB on Thursday. Going into a massive week ahead, Bramo. Central bank decisions, tons of economic data, and the biggest listed company on the S&P 500 reporting later this week as well.
Right, Apple coming out, I believe, on Thursday. As we talk about earnings, there are an ongoing slew of earnings even before then. We're about halfway through, and they've been better than expected. Today, before the opening bell, we get SoFi and Norwegian Cruise Line. After the bell, Avis Budget, MGM Resorts, and Vornado Realty Trust. The Vornado Realty Trust will be interesting on the commercial mortgage side. I am curious, though, about the discretionary spending, particularly when it comes to travel, because those shares have outperformed. Can they continue? Today, the annual Milken Institute Global Conference in L.A. is kicking off. There are a number of speakers there that are interesting. Apollo CEO Mark Rowan, Citigroup CEO Jane Fraser. Very interested to see what she has to say about this latest deal, as well as former FDIC Chair Sheila Bair, who came out and worries that the FDIC perhaps waited too long before doing this. And at 10 a.m., we get U.S. construction spending for March and ISM manufacturing for April.
Looking forward to the data a little bit later. And then on to Friday as well for Payrolls Friday. Here's the headline this morning, though. Jamie Dimon of JP Morgan winning the bidding to acquire First Republic Bank following an emergency government-led intervention. another one. Chris Marinac joins us now, Director of Research at Janney Montgomery Scott. Chris, we've been on this journey with you. We've appreciated it every step of the way. We've got some kind of resolution. I think what's interesting for us this morning is JP Morgan is positive in the pre-market. When they say things like our government invited us and others to step up, and we did, are they doing us a favour, or have they got something good here?
Well, I think they did both. I think they did us a favor because they were able to do this at a lower cost to the government. If you look at the bid that they made and the gain that they're booking, it's a lesser gain than what we've seen at the other transactions, particularly comparing the SVB First Citizens deal. First Citizens had a real excellent transaction a month ago. This is a less of a gain for JPM, but I also think it represents the upside to the wealth management business that FRC had. So that's really the honey hole that JP Morgan sees. And that's where I think that there's opportunity for them in the long term with the assets and the asset management clients.
Chris, is this a bailout by the FDIC?
Not really, because the FDIC could have made much better terms. I think that's ultimately why PNC or other bidders were not successful. I think JPM was willing to come in at a less of a bid, a less of a discount. So at the end of the day, the FDIC is seizing the assets. They are going to do a loss share, similar to other smaller transactions we saw back in 2008, 9, and 10. And really the SVB and signature transactions too. But I think at the end of the day, it's a better transaction for the system and the DIF.
Did the FDIC wait too long, Chris, to allow this crisis to continue, to allow the drip, drip, drip of good assets, of good workers at this bank to leave?
I think in a case of a week or two, yes, I would have preferred to see this resolved earlier in April. But at the end of the day, I think we got where we needed to go. I think they were trying to see if there was a private market solution, perhaps private capital, perhaps the equity markets would step up with the preferred or an equity raise, but that was just not in the cards for First Republic. So this was the best alternative.
Chris, when you read lines like, and you mentioned it a moment ago, that JP Morgan and the FDIC have agreed to share the burden of losses, what does that actually mean in practice? Can you explain that for our audience?
Sure. So as JPM now has the assets and deposits, they will work through those, and particularly loans. As they collect those loans, there'll be a loss share agreement for any losses that come out, and then that will be shared with the FDIC. It's very similar to what we had in 2008, 9, and 10. Typically, the assets back then were much worse. These are assets that are simply marked for interest rate risk, not for credit risk. So ultimately, I think you'll see JP Morgan sit with these assets and sell them and move forward. It's possible that much of what they are holding here comes back to them in the next 12 to 18 months. If interest rates change and the Fed changes policy, perhaps a quarter or two from now, that's going to have a sea change to how these assets are valued. So timing is everything, and I think that's ultimately why the bid ended up being less of a discount for JP Morgan than the other banks.
Did they share the upside as well then, Chris?
They capture most of the upside. So I think the upside all goes to JP Morgan.
That's fascinating, Bramo.
Well,
that's fascinating.
Especially because in the stories it actually said they shared the upside as well as the downside. So it's confusing that basically JP Morgan ends up with the entirety of the upside at a time where the FDIC wants to mitigate socializing the losses and privatizing the gains.
Chris, can you give us a little bit more clarity on that? What are you reading at the moment that gives you a better idea of what's going to happen there?
Well, I think the loss share agreement is going to be very typical to what we saw back in the transactions in 2008, 9, and 10. It was a very typical loss share arrangement where the FDIC seized the bank, they cut a loss share arrangement, and then the bank collected the assets. The bank becomes the conduit for the FDIC to collect the money, to collect the loans. It's less of an issue with deposits. It's much more with the loans that were made. And remember, the loans that First Republic had were largely low-rate mortgages with low loan to value. So these are not risky loans. In fact, in many cases, these are very low risk loans. They simply had interest rate risk because they were done at 3.25%, 3.5%, and the mortgage market today is closer to 6%.
Chris, as you know, and as we know, because we've talked about this over the last couple of weeks in a much bigger way, JP Morgan already held more than 10% of US deposits. Now, that's been seen as problematic for the regulator. Are we assuming this morning that that exception has been granted already just by the very nature of this being authorized at the moment?
Correct.
Okay.
Absolutely.
So can I ask the question then, does this become a problem if they hold more than 10% of US deposits? I assume that was a line in the sand for a reason. Why are we willing to go beyond it?
Well, I think at the end of the day, if you had to take a lower bid and therefore a bigger loss for the FDIC and for the Deposit Insurance Fund, it would have been problematic for the other banks. The other banks would have had to pay more than they already are paying. The cost of FDIC insurance will go higher in the coming quarters and next year. So if you could limit the hit to the DIF, to the Deposit Insurance Fund, that really is the best outcome for both the banks and for the system. So ultimately, this is about building confidence. And I think you build confidence, A, by having First Republic resolved, and B, by seeing that a very good operator who has strong capital, remember the fortress balance sheet that JP Morgan has always advocated, that allows them to do the transaction. I think it's going to be rare. I don't think we're going to see others like this. It really was the bank that was caught by the friendly fire of SVB 6 weeks ago.
Chris, is too big to fail a good thing now?
Well, not necessarily. I feel that the regional banks and mid-sized community banks are in a great position to step up and serve the businesses and the households of the country. So too big to fail is not necessarily the outcome that I'm looking for. I think there's many banks who are well capitalized that can step up. So to some regards, having this episode resolved is a good thing. I do think you're going to see that part of the credit solution in the country is seeing these mid-sized banks perform and perform well. I think you are correct that the credit is tightening, but I don't think it is being shut off.
Hey, Chris, wonderful to get your view on things. No doubt we'll catch up again soon. Chris Marinac there of Janney Montgomery Scott. As we have a deal, Bramo, between JP Morgan and First Republic, and I guess to be more specific, JP Morgan and the regulator this morning.
And it's a real question of how this is really going to play out with the financials. There were reports about possibly that JP Morgan would take a $2.6 billion net gain on its balance sheet and then $2 billion of losses over the course of 18 months to possibly work through this. And the FDIC would be settled with $13 billion of losses. So let's work through this. We don't know the details, but we'll be getting them trickling in over the weeks to come.
The market casting its vote. JP Morgan up in the pre-market by 2.65%. The broader equity market basically totally unchanged going into a massive week ahead. On that week ahead, Laurie Calvasina of RBC Capital Markets. The Federal Reserve decides on Wednesday. Payrolls on Friday. Apple earnings somewhere in between. On Wednesday, the Federal Reserve is set to hike interest rates after another bank in America essentially goes under. Another bank failure and another rate hike in the same week. It's kind of bizarre when you talk about it out loud.
Idiosyncratic, that's all.
Okay. Yields are higher by 3 basis points on a 10-year, 345.60 from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. As you've been hearing here in surveillance, JP Morgan has won the bidding to take over troubled First Republic Bank. The FDIC ran the sale after private rescue efforts failed to make up for bad investments and a run on First Republic's deposits. The deal will make the country's largest bank even larger. JP Morgan says it expects to have a one-time $2.6 billion gain linked to the purchase. House Republicans are challenging the Senate to pass its own debt limit bill. They're trying to increase pressure on President Biden to hold talks on spending cuts they've linked to an increase in the U.S. borrowing limit. The president has insisted the two topics shouldn't be connected. The U.S. runs a risk of defaulting on payments as soon as June. Russia targeted Ukrainian cities with cruise missiles early today. Ukraine's military says 15 out of 18 of them were shot down. Meanwhile, President Volodymyr Zelensky spoke with France's President Emmanuel Macron. Macron's office says they discussed Europe's coordination of military aid to be able to respond to the Ukraine's needs. In the UK, nurses are warning there will be no quick end to strikes. Members of the Royal College of Nursing staged another walkout Sunday night. Ambulance staff in some regions will also strike today and Tuesday. Meanwhile, another major health union, the GMB, voted Friday to accept the government's latest pay offer. And Japanese drug maker Astellas Pharma has agreed to acquire Iveric Bio for about $5.9 billion. Iveric, which is based in New Jersey, develops drugs to treat age-related blindness. The deal will be funded by cash and debt, and the price represents a 75% premium to Iveric's 30-day average through the end of March. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
I would be shocked if the Fed didn't hike interest rates by 25 basis points. The inflation data we got suggests that it's hotter than where the Fed would like it. And wages at 5.1% is going to worry the Fed.
Mohamed El-Erian, Bloomberg opinion columnist and Queen's College Cambridge president on Friday, looking for another rate hike this week, even after another bank failure. A solution this morning, JP Morgan taking over the assets and some of the liabilities of First Republic. And maybe that's the point here, Bramo, this morning.
That was the, at least, statement from both the FDIC and from JP Morgan that basically they're going to help mitigate the losses that could have been for the FDIC, because $13 billion of losses evidently was on the very low end.
Here's the market for you this morning, totally unchanged on the S&P 500. The bond market shaping up as follows. Yields a little bit higher by 3 basis points. The 10-year 345.22. Going into a key week, the Fed on Wednesday, payrolls Friday, Apple earnings on Thursday. We've got to start with the banking sector in America. Lori Calvasina joins us now, head of US equity strategy at RBC Capital Markets. Lori, does that deal over the weekend put this issue to bed?
Well, let's hope, John. I mean, we've been watching the KBW Bank Index performance very closely. We think it's become as important of a sentiment barometer as anything else that you can look at these days. And I think when we go back to the financial crisis, when we go back to the tech bubble, we look at things like WorldCom, Bear, Lehman, Enron. What we know is that the problem children in any crisis have to settle down before the market can settle down itself. And I think that if you look at that index, that bank's index, it's been trying to stabilize. It's remarkable, the resilience that we've seen. We know that earnings revision trends in small cap financials, which is a good proxy for regional banks, have been absolutely smoked. And that's something else that we really need to see happen in here before I think the market can be content with the idea that the pain is out of the way. So time will tell, John, but I do like what I'm seeing in the data.
SVB failed in March. The equity market rallied. First Republic was essentially going under in April. The equity market rallied. Laurie, can you make sense of that? The fact that we seem to have left behind the KBW Bank Index and the broader S&P 500 has carried on grinding higher.
Well, there's another child that the market's paying attention to, not just its problem child of the regional banks, but its, sort of oldest, stellar child, the tech sector. And the earnings there, I think, are in a recovery process. If you look at the rate of upward revisions, another good proxy for earnings sentiment, it got absolutely smoked last year for the TIMT space broadly. And it's actually in recovery mode this year. We're seeing things get less bad. We've even seen the tech sector briefly enter upward revision territory. And frankly, John, that is just the child that matters more to the market right now. It's just bigger in terms of its market cap representation. So the structure of the S&P 500 is in such a way today, and this is very different from what we've seen in the past. But if tech is behaving well, it also pre-traded the pause essentially, and is looking ahead to rate cuts. We can debate, whether or not that's going to actually happen. But basically, the recovery, the improving trends, and the positive interest rate dynamics for the tech sector have been enough.
Well, it's not just the tech sector, though, Lori. As you know, you've been tracking the earnings. And even in some of the consumer discretionary areas, you've seen consumers absorb higher prices. They have absorbed going around the world, traveling as much as they possibly can. At what point does the fact that even these bank failures that we're talking about not tighten credit enough to really do the work for the Fed, and that comes in as a potential surprise for markets this week?
Well, look, I do think that the Fed is likely to go ahead and hike later this week. That's basically priced into market. I think for the Fed to not do it at this point in time would spook the markets more than helping it. But I think that you have to always go back to the reasons why the Fed is doing what it's doing. And if the Fed is saying, OK, we can go ahead and hike one more time, we think this is a relatively contained implosion, we think that the economy is strong enough to go ahead and do that, that is a vote of confidence for the here and now. Now, I do agree with you that we're seeing a tighter lending environment coming up. I was listening to Bloomberg earlier this morning and liked what I heard one of the analysts saying about, this doesn't really seem like it's a cliff. It seems like it's something that's going to come in, in terms of dribs and drabs over the longer term. I think we have to go back and ask, what is sort of the state of the consumer balance sheets coming into all this? And I think the resiliency that you're seeing in terms of that consumer spending speaks to the fact that so much of a mess was cleaned up during COVID from all the stimulus programs and all the time that people were forced to spend at home. And that strength is now coming in, and it's an asset and a buffer for this economy, and it's showing up in those consumer earnings results.
Is the best way to play this in large cap companies and not necessarily the Russell 2000 that's more exposed to other banks that, as Charlie Munger said over the weekend, could be laden with some of these other bad loans, or at least underpriced loans based on where interest rates currently are?
I think, we go back to these crises that we saw in the past. If you go back and look at, sort of the big growth stocks back in the tech bubble, it took a very, very long time for those to become a leadership area again. And you can say the same things about the banks coming out of the financial crisis. So I think it's right to have some caution there. We've moved to a neutral on the financials, and we say that in small cap as well. They're cheap, but who the heck knows how cheap they actually are. I do think outside of the financials and small cap, you can find interesting things to play on a recovery thesis. Small cap consumer discretionary sector looks extraordinarily cheap right now and should benefit from kind of a recovery going into 2024. The same fundamental tailwinds that we would see in the big cap names, but the large cap consumer discretionary stocks are actually extraordinarily expensive right now. So we think there's a better risk reward in those small cap consumer names. I do, though, think, Lisa, as long as markets are kind of jittery, and as long as markets are focused on, kind of getting ready for Fed cuts down the road, I do think that tech is going to have some tailwinds. Now, we are watching the positioning there very, very closely. The NASDAQ futures are starting to get elevated. When that breaks, when that peaks, it's going to take down the tech stocks for a little bit. It's going to, impact the broader S&P 500 as well. But for now, I think the earnings trends are good. I think the Fed trajectory in terms of where the market expects to go is good. So I think you can be selective in small cap, but I do think that the tech space and big cap should do pretty well.
Laurie, you're not bearish. I just want to be upfront about that. You're really not. You've been constructive in some ways, in many ways, over the last few months. Laurie, how hard is it to convince someone to take money out of money market funds and put it in the equity market?
I think that it depends on what part of the market you're talking about, the time horizon you're giving investors, and the purposes that it's supposed to achieve. So one of the things we've been talking a lot about lately is the energy sector, which has really, really nice dividend yields, balance sheets that have been cleaned up. It's been kind of an orphan sector for the last few years. It's come back over the last year or so, especially with Russia-Ukraine in the spotlight. That's a pretty easy conversation to have with investors right now, even though there are some shorter-term concerns about oil prices. I do think at the end of the day, one of the things we see retail investors do is come into the S&P 500 for yield opportunities. And even though the growth sector, the growth part of the market is zigging and zagging right now in terms of, just all the strength we're seeing on earnings, there's some really interesting yield opportunities if you look in other sectors. Those aren't tough conversations to have, frankly.
Laurie, thanks for being with us. Laurie Calvasina there of RBC Capital Markets on a broader equity market that's faced down some decent earnings over the last week from the likes of Microsoft and Meta as well. This from Mike Gapon of Bank of America going into the Fed meeting on Wednesday. Enough juice for one more hike. He says the handoff to 2Q looks soft. He goes on to say, we expect the Fed to hike by 25 basis points next week, signal a pause in June with a weak upward bias for rates going forward from here. Morgan Stanley have said something similar. Lisa, they've talked about this conditional pause they expect the Federal Reserve to communicate on Wednesday. I guess my question would be conditional on what?
Right. And that's why I think that Tom would be sitting here in this seat if he were here being like, oh, conditional pause, what's next? Transitory conditionality of pausality. I mean, at what point are you just basically having, word salad at a time? We just don't know. Are they looking just basically at JOLTS? Are they looking at University of Michigan expectations of inflation? Are they looking at the senior loan officer survey? What are the data points that are going to be key? We don't know because it is a moving target.
Did you practice that over the weekend? Your
pretty
TK
much,
impression?
Pretty much. For 24 hours a day.
Nice. Well
Thanks.
Done. I mean, you've nailed it. It's really impressive.
I appreciate that.
Going into the Fed on Wednesday, as Lisa indicated, the Senior Loan Officer Opinion Survey. We should get a preview of that, potentially get a preview of that from Chairman Powell in the news conference. It was tightening before this mess. We're expecting it to continue to tighten. And then on top of that, you've got the potential for the regional banks to be tightening lending standards even more from that, which you just imagine is going to lead to tighter, not looser financial conditions and weaker, not stronger growth, right?
How much do you choose to trust your projections when they have failed so many times before? How do you project this out? It's not linear.
No. Very lumpy. The whole thing is. And will continue to be. As we've talked about it a few times, Bramo, it's a process. The start of one. Equity futures unchanged on the S&P 500. This is Bloomberg. Live from New York City this morning. Welcome to the programme on TV and radio. This is Bloomberg Surveillance. Alongside Lisa Abramowicz, I'm Jonathan Ferro. JP Morgan just putting out an investor presentation after securing that deal with First Republic. Here are some of the headlines for you. All regulatory approvals received. The transaction has closed. They'll make a payment of $10.6 billion to the FDIC on First Republic. Another headline for you. The FDIC will provide $50 billion in 5-year fixed-rate term financing. Within this PowerPoint presentation, Lisa, there's just a plate that essentially reads the rationale for the deal. Accelerates key growth opportunities, increases penetration with US high net worth clients, accelerates US wealth strategy by adding JP Morgan wealth centers in attractive locations, complementary to JP Morgan Chase's #1 business bank, financially attractive, high quality portfolio, they say, with additional protection, strong credit profile supplemented by FDIC loss sharing agreement. Loan portfolio marks supported by due diligence process, maintains JP Morgan Chase's fortress balance sheet, all those buzzwords. Bit of PR in the mix as well. Contributes to rapid and orderly resolution. First Republic depositors will be backed by the strength of JP Morgan. Lease a lower cost and most efficient option for the deposit insurance fund. Our capabilities and capital strength enabled a competitive bid.
And a little bit of detail with respect to the loss sharing agreement, saying that the FDIC will provide the agreements with respect to single family residential mortgages with 80% of loss coverage for 7 years. And then with commercial loans, including commercial real estate, of also 80% loss coverage for 5 years. Key question here is, how do the financials work? How much will the FDIC basically be taking on a lot of the losses while allowing JP Morgan to profit from the interest that they get every single year?
Just to point out, there will be a media call at 8 a.m. Eastern Time, an analyst and investor call at 8:30 Eastern Time. So a couple of things for the diary this morning. Media call at 8 a.m. Eastern Time, about 90 minutes from now. Analyst and investor call at 8:30 a.m. Eastern Time, featuring Jamie Dimon and the CFO. All of that's going to take place a little bit later on this morning. I've said a few times that the market has casted its early vote on this deal, with JP Morgan stock up by a couple of percentage points this morning. That's the move on JP Morgan. Of course, First Republic, the beleaguered bank. This was a triple-digit name not so long ago. It's trading in single digits now. I'll get you some more on that a little bit later. In a broader equity market on the S&P 500, equity futures look a little something like this. Futures totally unchanged on the S&P. On the Nasdaq, totally unchanged also on the Russell. We're negative by 0.1%. You would not have a clue that anything was happening based on those moves. In a bond market, the 2-year, 10-year, 30-year shaping up as follows. Your 2-year advancing by about 7 basis points. The yield, 4.0787% on a 2-year. Going into the Fed on Wednesday. The ECB on Thursday, leaving euro-dollar looking a little something like this on a single currency. The euro, 110.01, negative about 0.1%. Mike Dowder's with us now, the chief economist and macro strategist at Roth MKM Partners. Mike, you've gone through all of this stuff as well this morning, working through some of the details. I want to come to you on something you wrote about in the last week, Mike. You said there was an idea out there that some of this mess would be self-limiting because ultimately it would drive yields lower and bail out some of these losing positions that are held at some of these banks. And Mike, I didn't really hear that resonating with you at all. Mike, what's the pushback against that?
Well, I think the pushback is, what's the mechanism to really drive long-term interest rates lower? And the mechanism is weaker economic conditions, slower growth, potentially a recession. And if rates are falling as a consequence of a weakening economy, then we have to worry about weakness moving from securities portfolios to loan books. You guys have been talking a lot about the potential risks of the commercial real estate sector. So for the regional banks, they've been quite involved there. So I'm not convinced that this is quite over yet. And we should also consider the monetary policy backdrop. So the Fed is continuing to do quantitative tightening. The balance sheet is contracting every week now. There was a temporary jump with the discount window lending, but that's reversed now. And Wednesday, the Fed is widely expected to raise short-term interest rates again above 5% now. So you have an inverted yield curve, which is going to intensify. Very, very difficult for me to see this issue resolved with an inverted yield curve and with the reserve base that all deposits and money rest on continuing to shrink. So maybe I'm too pessimistic, but that's our view.
Mike, when you say, though, it's not over, does that necessarily mean that you think more banks are going to fall under, going to go under, going to fail?
Yeah, there are certainly more troubled banks out there. I won't do any calls on individual banks, but from a broader perspective, what I'm watching is commercial bank deposits are down almost $1 trillion in nominal terms from year-ago levels. And if we adjust for the previous rise in inflation, the entire bulge in deposits that was associated with the monetary and fiscal stimulus is gone right? So if we're thinking about this strong economy, high inflation, the raw material that fueled that has already completely reversed. And what we're left with is the Federal Reserve with a tight monetary policy in place. I would argue that short-term interest rates are well above neutral now. The balance sheet continuing to contract is going to put ongoing pressure on deposits and broad money growth. So from a business cycle perspective, we have had a pretty buoyant equity market this year, but I think these recession risks are still pretty material, and that means ongoing stresses in the banking sector are something we need to worry about.
People are going to be wringing their hands a lot today, talking about how JP Morgan had 16% of the deposits heading into this, and now are acquiring the more than $90 billion of deposits from First Republic. All things being equal, is consolidation in the largest banks sort of the groundwork for a more stable economy or a less stable economy?
It's a great question. I mean, you might get more stability out of this. I mean, we know there will be a lot more bank regulation following. The bigger banks are already more tightly regulated. And the impact on small business lending, commercial real estate lending, I think is going to be negative as this transition is made. So we have a lot of questions that are hanging out there, and a lot of business cycle risks, I think, that have been masked by this equity market backdrop that's been driven mainly by a handful of large cap growth stocks with very high valuations. And I think that sort of clouds what's actually going on in terms of the macro economy.
That said, Mike, haven't you been surprised by how positive some of the data has been that's been coming in, whether it's earnings of consumer discretionary or whether it's perhaps some of the data that we got over the past week?
Yeah, the economy has held up so far, largely because of a huge jump in January. February and March were a bit softer. And so we'll see how we go as the year progresses. One thing we're looking at is there is some fraying at the margin in some of the leading indicators for the labor market. So one thing we've been writing about is continuing jobless claims are up 22% now year over year. That's a rate of ascent that is completely unprecedented outside of a recession or just a few months before a business cycle peak. So it's important for listeners to understand that the economy always looks strong when you're close to a cycle peak just before recession. The unemployment rate is low, but potentially starting to inflect upward. Jobless claims are low, but the year-over-year trajectory is moving north. And there are some other signs as well. The small business survey, the NFIB data, is showing hiring plans pulling back pretty sharply, usually a good 6-month lead time over a rising unemployment rate. And so I just don't think we're out of the woods yet. Yes, earnings have not crashed, but they're coming in at a better expected pace against a fairly significant reduction in expectations beforehand. So there still is an earnings recession out there. We're still falling year over year on earnings, but we just haven't collapsed in a way that some had feared earlier coming into the quarter.
So if the Fed hikes 25 basis points this week and then just stays there for perhaps the rest of the year, do you think that would be enough to bring inflation back to 2% within the next 2 years?
Yeah, I think so. What's interesting to me is if you look at the TIPS inflation break-even market now, those spreads are actually starting to fall below mandate consistent levels. So the TIPS are based on the CPI, and the CPI data is going to run a bit above the PCE deflator, which is the Fed's formal target, usually 30 to 50 basis points. And we have 5 and 10-year inflation break-even spreads that are now just above 2%. So that would be consistent with PCE inflation right around or just below 2. And this is not a forecast of a two-handed economist. This is the marketplace. This is investors putting real money on the line. And it's a forward-looking mechanism. So it's not just the money supply growth in the inverted yield curve and the weakness in leading indicators, leading labor market indicators, but bond market inflation expectations are telling us that we will get back to 2% inflation, maybe even below that, but potentially also at the cost of a recession. And the hope is that if there is a downturn, it'll be short and shallow, but no guarantees in that regard.
Hey, Mike, appreciate the perspective. A little bit of a different perspective from what we hear every day. Mike Dowler there at Roth MKM. Just to go back over that slide presentation we received from JP Morgan, if you are wondering, of course, JP Morgan held more than 10% of US deposits. They would need an exception from a regulator to close this deal. They've pointed out that all regulatory approvals have been received and the transaction has closed. If you'd like some numbers for this deal, JP Morgan said it will make a payment of $10.6 billion to the FDIC on the First Republic Bank deal. This according to the slide presentation that JP Morgan put out about 15 minutes ago. Another line that I think is interesting, you'll have to remember that, of course, over the last month so much has happened, but I don't think we've forgotten that a lot of banks banded together a number of weeks ago to deposit $30 billion into First Republic. JP Morgan giving you some clarity on that as well. JP Morgan Chase will repay $25 billion of deposits from large US banks and eliminate a $5 billion deposit from JP Morgan Chase on consolidation. The stock up a little bit more in the pre-market, Lisa, in the last 10 minutes. We're advancing now by more than 3%.
I'm just really trying to understand the financials. I keep going over this. $500 million is the expected interest revenue that JP Morgan is saying that they're expecting to get per year based on the assets that they brought in. I just am trying to figure out how they came up with a loss sharing agreement and what this means in terms of a framework for other potential failures, because that essentially was what the FDIC member of the board was basically saying was we need a good framework to do this again so that we can share the losses, share potential recoveries. I don't know what that means with respect to profits, and then basically mitigate the situation for the depositors on hand.
So the potential for consolidation. Well, let's talk about the incentive for consolidation. Right now, why would you try and purchase a regional bank right now when you can wait for them to fail and then come up with some loss-sharing agreement?
It's a great question. I mean, why not wait for 1-800-FDIC bail me out?
Right.
And then, basically get some of the mitigation taken care of.
Get the terms that you want.
It's going to be a real issue for them.
The equity market just about unchanged on the S&P to negative 0.1%. Muted price action elsewhere in the bond market, yields higher by a few basis points. We'll catch up with Kathy Jones of Charles Schwab in the next hour. Looking forward to that conversation from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The nation's largest bank has become even larger. JP Morgan Chase has won the bidding to acquire First Republic Bank after it was taken over by regulators following bad investments and a run on deposits. JP Morgan will take over First Republic's assets, including about $173 billion of loans and $30 billion of securities, as well as $92 billion in deposits. JP Morgan will pay $10.6 billion to the FDIC. Meanwhile, regulators will provide $50 billion in 5-year fixed-rate term financing. In Sudan, the army and the paramilitary force it's fighting have agreed to extend a truce for 72 hours. There's been international pressure to let civilians safely leave the combat area. Meanwhile, water and food are becoming hard to find in Sudan's cities. Philippine President Ferdinand Marcos Jr. says he's determined to forge an even stronger relationship with the U.S. Marcos meets with President Biden today at the White House. The Philippines has granted the U.S. greater access to its military bases, paving the way for an increased American presence in the region. New economic data shows that China's recovery remains patchy. The latest indicators point to a contraction in manufacturing. Still, consumers splurged as the country began a 5-day holiday, and the housing market continues to rebound. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Playbook is not that different across different central banks. I think in many places it looks like disinflation is progressing, but progressing only slowly, and the central banks want to pause or want to step down the pace of tightening that they have been delivering.
That was Kamakshai Trivedi, the head of global FX and interest rates and EM strategy research at Goldman Sachs, joining us just last week. Equity futures on the S&P 500. Welcome to the program. Look at a little something like this. Totally unchanged on the S&P. Yields are higher by 3 basis points on a 10-year. 347, let's call it 346 actually, on a 10-year. Yields higher by 3 basis points or so. We have a deal between JP Morgan, the FDIC, First Republic, take your pick of some of the players in this. JP Morgan saying it will make a payment of $10.6 billion to the FDIC on the First Republic Bank deal, according to a presentation put out by the bank about 15 minutes ago. There will be a call a little bit later this morning, Lisa. I believe that takes place in about an hour and 10 minutes.
My favorite is imagining what this weekend was like for all the people at JP Morgan and the FDIC who had to go through all of the paperwork and come to some kind of agreement. JP Morgan said 800 employees were involved in First Republic diligence. You can imagine that they all lost their weekends and they all were basically up all night as they tried to figure out what they could be missing with this potential transaction.
I wonder if they have managed to get any sleep this morning. Herman Chan's dropped by, Bloomberg Intelligence Senior Regional Bank Analyst. Herman, wonderful to catch up with you, sir. You've worked through that presentation a little bit as well. What jumps out for you?
Yeah, what jumps out to me is that JP Morgan's acquiring substantially all of the assets. So both the underwater securities and the underwater loans from First Republic. If you look at the other transactions that have happened over the past month with SVB and with Signature, the securities were left with the FDIC. So this essentially is a better deal for the government because they're taking over substantially all the assets.
So there is a loss-sharing agreement, and as Lisa and I have been discussing, we're trying to get some clarity on how the upside is shared as well. Can you walk us through your understanding of that?
Yeah, so the loss-sharing agreement really is to protect the acquirer if there's any credit losses, charge-offs within the portfolio over the life of those loans. Any potential losses over a certain amount would be absorbed by the FDIC. So that's usually how that works. That's typically a part of any FDIC transaction. These types of loss share agreements were in place during all of the failed banks during the financial crisis. So that's par for the course.
What does this mean in terms of what additional regulations are going to be put on some of the regional banks to prevent perhaps loans that are extended to wealthy individuals where they don't have to pay interest or principal for 10 years, things that might now in retrospect be considered not as responsible?
Yeah, that's right. We would expect more on the regulatory front, both in particular liquidity and also capital. So those are two things we're focused on, how these regional banks with $100 billion in assets or more will now have to have more liquidity requirements in place, potentially having to assess the liquidity with relation to uninsured deposits, and also tweaking the capital ratios, including the unrealized losses on the securities book and incorporating those unrealized losses into the capital calculations.
So perhaps this is going to be debated, whether it's a bailout or not, but people are going to be looking at this and saying, what does this set in terms of a precedent for other banks that might go under and potential suitors who might want to come in but want a sweet deal where they are guaranteed to not absorb a lot of the losses? I mean, basically, is there moral hazard embedded in this deal that sets a pretty daunting framework for the FDIC?
Right. Our base case with the whole First Republic situation is that any potential acquirer would not do a transaction unless there was an FDIC backing in terms of the loss share agreement and other sweeteners. There was a potential fixed borrowings from the FDIC that helps with JP Morgan as well. So those two things were a necessary requirement for JP Morgan in our view. So any sort of failed bank or teetering bank would require these sort of actions before an acquirer would come in.
Herman Chan, thank you, sir, of Bloomberg Intelligence. Just some clarity on the loss sharing and the sharing of the upside, potential upside as well. We caught up with Chris Marinac of Jenny Montgomery Scott in the last hour, and he pushed back against the idea that the upside would be shared. He acknowledged this. I had a follow-up email exchange with him. He said, technically, yes, there is a sharing of any upside on the gains as the assets, i.e. mostly loans, are collected. But he went on to say, Lisa, this: I feel the true upside for JP Morgan is getting all of First Republic clients banking and wealth management for free, which translates into a $2.6 billion gain. And that's going to happen year after year after year after year. And I guess Chris's point is that's the kind of upside here that's not going to be shared with the FDIC.
It's a good point, especially when you look at just the brutal numbers of $2.6 billion in realized gains on the books. Yes, there might be some losses, but that interest gain that we've been talking about that they get year after year, in addition to just amassing a greater base and a greater dominance, you're right. This is definitely a benefit to JP Morgan. And yet it mitigated the losses to just $13 billion for the FDIC.
Reflected in the stock this morning. For now, at least, the stock is up. JP Morgan's higher by a little more than 3%. Ed Carnage of Bloomberg Economics joins us right now. And the Federal Reserve on Wednesday Does this change anything for them?
Well, it was interesting being here Friday, Jonathan, seeing the blame game play out over the banking scare. Obviously, they're expected to go by 25 basis points this week, but you'd have to think that this may give some reason for caution going forward to the Fed. Remember, when the banking scare started, we were told these were very idiosyncratic factors, particular issues with individual banks and the like. But here we are on another Monday morning with another bank being taken over by a mega bank. So I think at the very least it will give pause for some policymakers. We're told that central bankers keep going until they've broken something. Maybe they have broken something now in the financial system. So I would expect this will be a talking point for one of the reasons why the Fed might go on pause after this week.
Well, certainly something's breaking. Many things are. Many banks have over the last month or so. And from the moment we had the SVB debacle, everyone started talking about the Senior Loan Officer Opinion Survey, which comes out in early May. Lisa's talked about the date repeatedly, May 8th. And will the chairman have that? Can he offer a preview of that on Wednesday?
Well, at the very least, you'll have to acknowledge that there's a lot of discussion about a credit slowdown. Not quite a credit crunch yet, but certainly a credit slowdown in the economy. And that goes to the very core of what's happening, John. We know that consumers are weakening a touch. There's a hint of softness in the labour market. And we know, of course, that the GDP figures were slow last week. So if you are a Fed chairman and you are waiting for loan data, you're obviously going to be expecting some kind of an impact from what's happened to the regional banks. And that's another one of the reasons why the Fed are probably going to be, after this week's hike, they're probably going to be somewhat more cautious, I think, going into the second half of the year.
John was asking earlier, what is going to be the data that they look at? What is the conditionality of some potential pause at the June meeting? What do you think right now has the greatest import in terms of data, especially if, yes, a senior loan officer survey may be interesting, may be informative, but also may be very lagged and not reflect the real pace of tightening?
It's a tricky one for them because, again, if you go back to Friday, Lisa, we had the employment wages data that came out, and that showed basically that compensation in the US remains pretty firm. And of course, the Fed have been paying a lot of close attention to what's going on with wages data. That's not going in the right direction. But of course, we know at the same time that growth is slowing down. We had the GDP figures for last week as well. So there's starting to be something of a divergence in the data going on in the US. From what I've seen here, we do have pretty sticky inflation, especially in the core services sector. We do have wage growth remaining somewhat relatively robust. And at the same time, growth is slowing down. Now, of course, overshadowing all of that is what's going on with the banking system. And as you say, even if it's a lag, we know there's going to be a hit to the loan data. We know there's going to be a hit to the credit crunch. So it's going to be a big call for the Fed, not necessarily this week, but it's going to be a big call, I think, for what to do in the months after this.
Hey, Enda, wonderful to get your view, as always, down in Washington. Bloomberg's Enda Karen. Just wondering whether we get any dissent anytime soon at the Federal Reserve. Are we at that point, Lisa, where things start to just diverge on a committee a little bit?
Is there public dissent? I am sure that behind the scenes there is dissent, but how do they create a feeling of confidence and dependability at a time where they already have had their reputation somewhat damaged by a number of missteps that people keep saying, perhaps in retrospect, really exacerbated the inflation problem that we have?
Just to go through a couple of times for you this morning, JP Morgan hosting a media call at 8 a.m. Eastern Time. An analyst and investor call will take place 30 minutes after that at 8:30 Eastern Time. So the first call taking place in about an hour and 5 minutes from now. On that call will feature the CEO, Jamie Dimon, and the CFO as well. So, Lisa, looking forward to that a little bit later this morning. Any questions that you've got at the moment that you'd like to hear asked, answered on those calls?
Just basically the loss-sharing agreement, what they actually demanded, why they waited so long, what they were waiting for, what the FDIC agreed to that was sort of the deal, the clincher for them to actually get this deal over the line, because we know the FDIC has been trying to get this auction across for a while. Haven't had bidders. Too big to fail becomes even bigger. JP Morgan up by 2.9% in the pre-market. The broader equity market virtually unchanged on the S&P 500 through this morning so far. Michael Schall of Marketfield Asset Management will be joining us in about 5 minutes' time in the studio, I believe. Looking forward to that conversation with Lisa Abramowicz. I'm Jonathan Ferro. TK taking a day off. He's going to be back with us tomorrow morning.
This is a cycle where we're unwinding massive COVID distortions.
When we talk to firms, they're still trying to hire. They're still trying to find people.
Our view is that economic momentum is going to be downshifting here over the course of the next year or so.
For the Fed, it's mostly a question of how quickly do they go back to neutral, which would be around 3%, and my guess is not very.
Everyone believes that there's going to be a rate hike in May, but almost no one is talking about beyond May.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
What a way to start the week, and a busy week at that. Still ahead from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio with your equity market virtually unchanged. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Anything but unchanged about the financial industry in the last 6 weeks or so. JP Morgan winning the bidding to acquire First Republic in an emergency government-led intervention over the weekend. Lisa, this stat right here. This coming from our team here at Bloomberg. For just over 1 month, SVB was the second largest bank failure in US history for just over a month, because that title now belongs to First Republic.
At a time when people are still saying idiosyncratic, people are still saying this is a resilient system, this is something that is going to be contained. This is the real issue. What does this mean in terms of what the FDIC itself deemed the country's bailout culture, and what does this mean for other banks that they say will inevitably fail because that is part of a healthy ecosystem of a capitalistic society?
Does this feel healthy over the last couple of months?
I would think that pretty much everybody would say no. Nothing about this has seemed healthy, especially because there were banks that were not hedging against interest rate risk. There were banks that were extending loans that didn't require any kind of interest or down payments for 10 years. That is a concern.
JP Morgan up in a pre-market, seemingly. The markets believe this is a healthy deal for JP Morgan. We'll return to that in just a moment. On the S&P 500, unchanged on equity futures through most of this morning off the back of some of this. In the bond market, yields higher by 3 basis points on a 10-year, 345.22. The euro slightly negative here, Lisa. Euro dollar down by about 1/10 of 1%, 110.10.
A massive week ahead. We've got the Fed, we've got the ECB, we've got a slew of earnings, and we have on Friday jobs report. Today, quieter on that front. We do get some earnings from Avis, MGM, Norwegian Cruise, just a sense of where the consumer discretionary is at because it has been outperforming. The annual Milken Institute Global Conference is kicking off in LA. Interesting to hear what Jane Fraser of Citigroup and former FDIC Chair Sheila Bair have to say about what just transpired in the banking sector, whether this was a good deal that the FDIC struck. And at 10 a.m., the latest with respect to data ahead of tomorrow's JOLTS information. We get construction spending for March and U.S. ISM manufacturing for April. Do we see some sort of, green shoots of a recovery there, John?
Looking out for the data going into payrolls on Friday. The big story for us this morning, JP Morgan taking over First Republic's assets, including about $173 billion of loans, as well as $92 billion in deposits. Michael Schauer, CEO of Marketfield Asset Management, joins us around the table. Michael, what do you make of this one this morning?
I think it was the most likely outcome going into Friday. I mean, the rumours were heavy that JP Morgan would be stepping up and buying this, and the sort of mix of risk and opportunity is similar to the way that Silicon Valley Bank, was sort of parceled up and Signature Bank have been parceled up. I mean, I think for JP Morgan, they probably look at this as a way to expand their wealth management relationships. And they probably have a big enough balance sheet that they can absorb the interest rate risk and the mismatches which existed within First Republic.
How many banks need to fail before we stop calling this idiosyncratic?
It's a good question. I mean, it's not only how many, it's, what's the size of them. There clearly is something systemic here. I think the question is whether or not it's only within banks that interest rate risk has been mismanaged or whether there's a general problem. I mean, there's an awful lot of private sector credit. This time around, there's been an awful lot of use of leverage, for sort of general business purposes. Most of it was off floating rates. I mean, my concern is not so much the banking system, which looks fairly solid still. It's more whether or not, the dramatic change in interest rates over the last 12 months starts to really make itself felt in general business conditions.
There's a belief that this is interest rate risk. This is not credit risk. There's a belief that consumers, businesses will pay back their loans if extended the maturities long enough. Do you push back against that?
Yes. I mean, I think in the end it will be a credit cycle. This has started off being an interest rate cycle, and what's fascinating is that banks can fail while their loan books are performing as well as all of these banks' loan books were performing. I do think that by late 2023, I think sort of interest rate mismanagement, whether it's borrowing too much or lending too much, and assuming that interest rates are going to stay too low, is going to be fairly obvious.
But how long do you have to wait to see the data confirm that belief? This has been one of the challenges for people who have been bearish, who've looked around and seen some of these problems that they expect to come and haven't come and have been prolonged, and we've gotten better than expected data. So how do you sort of remain bearish at a time when the data isn't that bad?
I don't think the economy is that bad. I think it's very specific portions of the market, which have problems. I'm not particularly negative on the S&P. I'm negative on people that employed leverage as an excessive part of their business plan.
The S&P hasn't really done anything for months. We've had this really tight, well-defined trading range of 3,800 to 4,200. I can recall a conversation I had with you a number of months ago, and you were really out front on this, together with maybe a couple of other people, that perhaps we face the prospect of a long, long time without big returns in the US equity market. Have you given more thought to that, Michael, after the events of the last couple of months?
I mean, I don't think I've really changed my mind. I mean, I think you have 10, 15 years of the sorts of returns that we had, and as I say, I'm one of the people who assumes that interest rates stay higher for longer. I think it's going to be difficult for the headline index, to get to that 5,000 level that seemed within touching distance 15 months ago.
5,000 over what time horizon? Are you talking years?
Yeah,
How many?
I think years. I think anything longer than 5 is forever in this business.
So you think that over the next 5 years, it's incredibly unlikely we break 5K on the S&P 500?
I may get rid of a line incredibly. I would say unlikely.
Okay. That's quite a change from what we've experienced over the last 10. What do you think is going to change about the way people invest that's going to lead to those kind of outcomes?
I think it may be more sector-based as opposed to headline index-based, and I still believe that international is has a bigger place in portfolios than it's had for the last 15 years.
So at this point, when you look out to just how much there isn't necessarily the upside, is there still going to be this tech dominance where Microsoft and Google account for 14% of the entire market cap of the S&P?
Yeah. I don't think so. I think other things are going to do better than technology over the next few years. I think breadth within technology has narrowed. I think there's less companies that look like must-owns than you had. But as I say, I don't think technology is exactly the problem this time around. They haven't been excessive users of leverage. I think technology's problem is more valuation. It's more an ability to grow at the rates that people have become used to, they may transform themselves from very fast-growing organizations to stable, perhaps less interesting organizations. That's a valuation issue.
Where is the leverage? Because so many people talk about a lack of leverage across a range of issues and a range of parts of this market as well. They say things like short and shallow recession because we haven't built up the leverage this time around in this cycle.
I think there's tremendous private credit. Private equity is an example of that. But I think the extension of non-banks into lending, whether it's first loans or mezzanine loans, has been remarkable over the last few years.
But what's going to challenge that? I mean, basically, you think that interest rates are going to remain higher, but every private equity, every private credit person who comes on says that we have the assets, the banks, the companies that we invested in are doing just fine, and we haven't seen the losses really percolate out.
I think you haven't, but if I look at the way people put business plans together 18 months, 2 years ago, and the world we live in today, there's a complete mismatch between what people expected and what's actually happened and what their operating conditions actually look like today. And I believe that non-performance or poorly performing loans are going to be an increasing factor as 2023 matures.
What do you like right now?
I still really like precious metals. I was on the day that SVB went down and said that this felt like a turning point for gold. I think the battle between gold and 2000 is really key, not just for precious metals, but for the overall commodity complex. Because I think if gold can establish itself above 2000, really for the first time in its history, that'll be the first victory for commodity bulls, since that sort of post-COVID run up 2-3 years ago.
Why is that going to compete well with a money market fund, giving me yields that I've not had for a long, long time?
Well, I think it already has. I mean, I think if you look at gold versus pretty much all fixed income, whether it's long duration, short duration, high yield credit, high quality credit, gold has actually outperformed over the last 5 years. So I think gold has been in a stealthy bull market. I think people mistakenly hold it up and say it looks like the S&P 500. It doesn't. It's not a high growth equity. But I think as a store of value, gold has quietly had an extremely good 5 years. And what you really haven't seen is that embraced within portfolio flows. But I think gold versus fixed income, gold's the winner.
Because the way that some people still think about it, Michael, is they think about it through the lens of what's the opportunity cost of holding gold. If I can get 4 to 5% somewhere else, why would I hold this? I get no yield.
I think
what's the pushback?
for many years, people were willing to hold almost no interest rate bonds looking for a total return. And it was a very successful investment strategy. So I don't think gold's lack of coupon competing against a 5% T-bill is really that much of a problem.
Interesting. Well, it hasn't been, as you indicated.
Right.
Michael Shao of Market Field Asset Management. Michael, this was great to catch up.
Thank you.
Thank you, sir. Tough time for the financial industry, Lisa, this morning.
Especially at a time when, as Michael said, we don't know what the interest rate risk, how much that's going to translate into credit risk. And that, I think, is the unknown going forward. Because right now you have people who are still able to pay back their loans. But if you do get some sort of ongoing recessionary environment, or at least weakness, it might become a credit risk as well.
Just to go over the top line then, JP Morgan to acquire failed regional bank First Republic. That news coming out several hours ago. Just some times for the diary this morning. I'll keep repeating them just in case people miss it. JP Morgan hosting a media call in about 50 minutes from now. We'll bring you the headlines from that. An analyst and investor call will take place at 8:30 a.m. 30 minutes after that media call. That will feature Jamie Dimon and the CFO of JP Morgan as well. Looking forward to hearing what they've got to say about this deal this morning. Also looking forward to this conversation in the next hour on Bloomberg TV and on Bloomberg Radio. Vishy Tirupattur of Morgan Stanley on the banking sector, on fixed income, and looking ahead to a big week ahead with the Federal Reserve on Wednesday, payrolls on Friday, Apple earnings after the close on Thursday. From New York City this morning, good morning with Lisa Abramowicz. I'm Jonathan Ferro. TK back with us tomorrow morning. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. JP Morgan has won the bidding to take over troubled First Republic Bank. The FDIC ran the sale after private rescue efforts failed to make up for bad investments and a run on First Republic's deposits. The deal will make the country's largest bank even larger. JP Morgan will pay $10.6 billion to the FDIC. Meanwhile, regulators will provide $50 billion in 5-year fixed-rate term financing. House Republicans are challenging the Senate to pass its own debt limit bill. They're trying to increase pressure on President Biden to hold talks on spending cuts they've linked to an increase in the U.S. borrowing limit. The president has insisted the two topics shouldn't be connected. The U.S. runs a risk of defaulting on payments as soon as June. Tim Scott is teasing an announcement later this month on his expected run for the White House. The Republican senator from South Carolina says he'll have an announcement on, quote, the final step May 22nd. Scott has already set up an exploratory committee. Russia has targeted Ukrainian cities with cruise missiles early today. Ukraine's military says 15 out of 18 of them were shot down. Meanwhile, President Volodymyr Zelensky spoke with France's President Emmanuel Macron. Macron's office says they discussed Europe's coordination of military aid to be able to respond to Ukraine's needs. Japanese drug maker Astellas Pharma has agreed to buy Iveric Bio for about $5.9 billion. Iveric, which is based in New Jersey, develops drugs to treat age-related blindness. The deal will be funded by cash and debt. The price represents a 75% premium to Iveric's 30-day average through the end of March. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Ultimately, this is about building confidence, and I think you build confidence, A, by having First Republic resolved, and B, by seeing that a very good operator who has strong capital, remember the fortress balance sheet that JP Morgan has always advocated, that allows them to do the transaction. I think it's going to be rare. I don't think we're going to see others like this. It really was the bank that was caught by the friendly fire of SVB 6 weeks ago.
That's the latest on the mess between the banking sector, JP Morgan, First Republic. Take your pick. JP Morgan winning the bidding to acquire First Republic Bank in an emergency-led government intervention. JP Morgan will host a call on this in about 42 minutes from now at 8 a.m. Eastern Time. An analyst and investor call will take place 30 minutes after that at 8:30 Eastern Time. Those calls will feature Jamie Dimon, the CEO, and the CFO of JP Morgan as well. The team here at Bloomberg just going through the stats, historically, what this all means. This line here, that just over 1 month, for just over 1 month, SVB was the second largest bank failure in US history, and now that title goes to First Republic. So we've had the number 2 and number 3 biggest bank failures ever in this country over a couple of months, and the S&P rallied in March, the S&P rallied in April.
John, do you think that we've made enough of the fact that the FDIC encouraged big banks to deposit $30 billion with First Republic and that nothing came of that, that didn't really stave off the pain, the losses, et cetera, the stopgap measure that didn't work, that still forced them to basically come to the table to share the losses in this acquisition that JP Morgan made?
Big questions. We'll try and answer them now. The stock is up by 3.7%. in a pre-market. Let's get to David Chiaverini, the Equity Research Managing Director over at Wedbush. David, just to start with a simple one for you. How did you respond to this one this morning? As expected, not surprising to you?
Not surprising at all from the standpoint that JP Morgan really is a natural fit for the acquisition of First Republic. JP Morgan's been a longtime advisor for them, so it knows its customer base very well. It knows its business model very well. So it just makes sense for First Republic to be a part of a large money center bank like JP Morgan, given its cheap source of deposits. And remember, First Republic was once part of another money center bank, Bank of America, and that was spun off in 2010. So initial reaction is not surprising that it went to JP Morgan, and it makes a ton of sense for JP Morgan to make this acquisition.
You heard this line from Chris Marinac, the Director of Research at Janney Montgomery Scott, just moments ago. Chris basically said that this was the bank that was caught by the friendly fire of SVB 6 weeks ago. Now, I wonder, David, from your perspective, how many other banks you think are still going to get caught by the friendly fire of SVB from 6 weeks ago?
Yeah, it's a fair question, and that's a question that a lot of investors have been asking. And really, in the immediate aftermath of SVB and Signature Bank going down, investors essentially did two types of analysis. One was they looked at who had the most uninsured deposits, and then they also looked at who had the most unrealized losses, both in terms of securities as well as loans. And First Republic was very vulnerable from that standpoint. Now, some other banks were also screening poorly in that regard, and they've since kind of shored up their deposit base by increasing the level of uninsured deposits. But companies like PacWest, Western Alliance, CVB Financial, those are companies that were screening poorly, but since then have really gotten their deposit base in much better shape from an uninsured standpoint.
That said, longer term, David, does this make certain regional banks, I don't want to say uninvestable, but much less investable, given the fact that the FDIC is very likely to increase regulation in response to what we just saw with SVB and First Republic?
Well, there's certainly going to be headwinds for the banking industry. Now, this does, the resolution of First Republic should be idiosyncratic from my viewpoint, and I would think that the group could see a little bit of a relief rally because of this. But looking out over the next 3, 6, 9, 12 to 18 months, the banking group does have a lot of headwinds facing it because the cost of deposits is going up, the cost of funding is going up, so net interest margins are going to come under pressure. We've seen a lot of headlines about commercial real estate and office, so I am expecting the economy to slow and credit costs to pick up as well. So I don't think we're out of the woods yet, but I wouldn't go as far as saying that the group is completely uninvestable.
You said that some of the banks like PacWest and Western Alliance had shored up their balance sheets in a way that gave you confidence that they would be okay. How do you determine that? What are they doing that can actually get ahead of this? If we heard the same kind of thing from First Republic, that they were getting ahead of it with a $30 billion infusion from the biggest banks of America.
Yeah, the way they're doing it, and it's becoming increasingly more popular over the past month or so, is using ICS, which is Insured Cash Sweep, this service. in which companies can essentially, on a reciprocal basis, swap out uninsured deposits for insured deposits at the same cost between banks, and they pay a small fee of 10 to 15 basis points to do so. So we're seeing Western Alliance make increasing use of that. And the problem with the issue with First Republic with that 30 billion is that that was exactly that 30 billion of deposits rather than equity. And given that they were so negative on tangible equity, that's what ultimately did in First Republic, at least in my view. Now, PacWest and Western Alliance, they aren't negative on a tangible equity basis. In fact, we saw an incremental increase in terms of what their tangible book value is on a fair value basis. At least in the case of Western Alliance, it went from $3 a share at December 31st to $16 a share at March 31st. So we saw an incremental improvement from that standpoint.
We heard from the FDIC, a member of the board who came out and said that there are many steps that need to take place to fight bailout culture that has become so endemic in the United States. Do you think this deal puts the FDIC closer or further away from fighting bailout culture?
You know, I don't think bailout culture is a new thing. In fact, what banks are going to do going forward after viewing what's happened over the past month and a half is likely to run their banks that much more conservatively. They're likely to carry more liquidity. They're, of course, going to manage interest rate risk that much more. And if to the extent that they do go long term with some of their loans, they're likely to swap that out with derivatives to keep them on the right side of that interest rate risk. So bailout culture, I don't think that we're going to see, banks really, go down that road and think that they're ultimately going to get bailed out, because, banks aren't in business with the standpoint of let's act risky, because worst case scenarios that we get bailed out, because, shareholders, of course, get wiped out in that regard, both common and preferred, and no bank management team wants to be overseeing that.
So, David, why do these banks keep failing?
Yeah, it goes back to the interest rate risk in this environment. And that's what makes this so unique, is that in history, rarely, if ever, have you ever seen a bank go out of business because of interest rate risk. It's normally credit quality. It's usually bad loans that take banks down. In this case, the unprecedented increase in interest rates from the Fed over the past year to year and a half is what ultimately took down all three of these banks.
David Cheverini there of Wedbush. Thank you, sir. Thank you very much on the latest. Another bank to go. We had SVB, Signature Bank, Silvergate, First Republic. If you want to count the international story as well, throw in Credit Suisse. I make that 5 in just a couple of months, Bramo, and we've talked about this now over the last couple of hours, that for every single institution you could make the case that it was idiosyncratic. It's happened now 4 or 5 times in just a couple of months.
There have been a number of stories about how some of these banks did not hedge against interest rate risk. They actually lowered their hedges last year amid some of this fastest pace of rate hikes that we've seen in 40 years. This raises a question: how do you measure risk? And were regulators effectively measuring risk on balance sheets when it was clear it was tied to something that another hand of their same agency was doing?
Every Monday morning we've done this. We've asked, is that it? Is it over? And you get the feeling from people this morning that they're like, yeah, we hope so. But
we hope so.
Are we going to do this again on another Monday morning coming to you sometime soon?
This honestly seems like people are kind of girding for it, but are they really?
Live from New York City this morning. Good morning. Welcome to the program. This is Bloomberg Surveillance. Your top story this morning: Jamie Dimon's JP Morgan Chase winning the bidding to acquire First Republic Bank in an emergency government-led intervention. JP Morgan will take over First Republic's assets, including about $173 billion of loans and $30 billion of securities, as well as $92 billion in deposits. The bank and the FDIC, which orchestrated the sale, agreed to share the burden of losses, as well as any recoveries on the firm's single-family and commercial loans. Here's the quote from Jamie Dimon. Our government invited us and others to step up, and we did. Our financial strength, capabilities and business model allowed us to develop a bid to execute the transaction in a way to minimise costs to the Deposit Insurance Fund. There will be a call in about 30 minutes' time at 8 a.m. Eastern Time. An analyst and investor call will take place 30 minutes after that. So media call first, investor call second. And that will feature, Lisa, Jamie Dimon and JP Morgan CFO.
Talking about what the transaction really entails and how much upside potentially there is at a time when there still are so many questions about loss sharing, as well as what kind of oversight this means of JP Morgan. The fact that they already accounted for, 16% of total deposits in the United States, now acquiring more and given permission because normal rules would ban them from making further acquisitions to consolidate their market share.
RBC weighing in on this deal. A lot of the South Side will this morning. Anyone who covers JP Morgan. Overall, we view this as a very positive transaction for JP Morgan, one which should help drive long-term returns higher for its shareholders. It just seems to be that's the conclusion this morning. Good news for JP Morgan, good deal.
Well, and what does this mean then for the FDIC? Okay, for JP Morgan, we've established it's good news. What does this mean in terms of bailout culture? What does this mean in terms of other banks that may fail, and what kind of regulations go on regional banks at a time when a lot of lawmakers want to see those banks fostered, want to see them actually go forward and continue to make loans? It really is a tense moment going forward from here.
Kathy Jones with us around the table from Schwab. Kathy, wonderful to catch up with you. I can't believe this is the first time we're talking in person in something like 3 years, because I get to talk to you so often. It feels so bizarre.
I know. It's just great to be back in the studio.
Yeah, wonderful to be with you. This is another bank that's gone under in the United States of America. Another last-minute deal, spending the whole weekend negotiating this mess, and here we are. The Federal Reserve gets to decide to hike interest rates on Wednesday, and seemingly is going to go another 25 basis points. And I'm sure you've heard the same commentary we have, that every single bank that goes under is idiosyncratic, and this isn't about what the Federal Reserve's done. In fact, we heard from John Williams, the New York Fed president, just say a couple of weeks ago that he doesn't think it's because they went from 0 to 5 so quickly. How do you respond to that?
Oh, I think it has a lot to do with how much the Fed has tightened and how rapidly they've tightened. You know, the old saying that the Fed tightens until something breaks. I think that clearly they've moved at such a rapid pace that there's an impact on financial stability, and we're seeing it in some of the banking areas. Now, it doesn't mean that credit risk, which is what they normally get concerned about, is a big issue. But I think it's hard to divorce the Fed's actions from what's happening in the banking sector.
Do you think it gets worse then, given that they're going to keep on hiking, or at least will hike one more time this week?
Yeah, we're kind of hoping this is the last rate hike, but it tells you a lot about this Fed that they hiked in March when we had banking sector problems, and they look like they're going to go ahead in May when we have banking sector problems. One would think that this is probably the end of the rate hike cycle at this stage of the game.
I wonder what kind of key man risk there is for the Federal Reserve at this point, given the fact that on Friday they did put out a report talking about what went wrong with SVB. It seemed to have passed into the backview mirror. But there are ongoing questions about how accurately they are regulating some of these banks. I mean, is this potentially going to, upend the leadership at the Fed at a certain point?
Well, I would think at least we're going to get some dissenting votes this week, or at least one or two. And I think that, they have to reconsider the regulatory environment that they're in as a banking regulator and supervisory capacity. So I would think, I don't know. I don't have any particular predictions on that, but I do think that there may be certainly some rewritten rules and certainly a reexamination of what's been going on.
We were just talking with Michael Shaul, and he was talking about how for now it's interest rate risk, but that eventually it could very easily become credit risk, especially as a lot of companies and individuals have trouble paying back such high rates. What's your sense of just how significant that credit risk is and whether it's accurately reflected in where the market is right now?
Yeah, one thing that we've seen is the credit spreads really haven't blown out in the way that you would anticipate given what's gone on in the market. So we do think that there's some risk of widening, where I think the bank loan sector certainly is vulnerable. Private credit, we don't know what's happening there because they don't mark to market, but you have to think that there's some bad loans there that are having to be restructured. And the high yield spreads have been much tighter than I would have anticipated at this stage of the game.
Just very specifically, after SVB happened, and now First Republic, some people were saying they were going to come in and buy bank bonds that had gotten beaten up because, particularly for regional banks, that there was still value there. Gerard Cassidy of RBC put this out where JP Morgan is not assuming First Republic's corporate debt or preferred stock. Does this raise another risk, another layer of risk that makes that proposition perhaps less valuable than some people were arguing initially?
Yeah, you've seen bondholders and equity holders and preferred holders get washed out in these deals. So I think you have to be pretty selective when you're looking at the banking sector now in terms of the bonds. Again, I think they're good bonds and they're not so good bonds, and maybe there's some opportunities there. But I do think you have to be really selective.
Kathy, stick with us. I just want to get to our colleague Sri Natarajan of Bloomberg, who's been running through some of these headlines that have come from JP Morgan and First Republic this morning. Sri, great to get you with us on the phone. Just go through your top takeaway this morning off the back of this deal.
Look, the main thing is clear. We had a marathon weekend. This was all the bids were due by Sunday noon, but this went well into the night, and it wasn't until 3:30 this morning that we got the final decision that JP Morgan was indeed the winner. The first question and the one thing that you already raised was, how do you allow a big bank to get bigger, especially when there is a cap for banks that already control more than 10% of deposits, and JP Morgan is well over that figure. But ultimately, the calculus here, I believe, had to be what bid is out there that will result in the smallest hit to the FDIC, and that appears to have been the JP Morgan decision. At least that's why they have gone with JP Morgan. And you still see that the FDIC taking a $13 billion hit on the diff, agreeing to a loss-sharing agreement with JP Morgan, but there's upside to that they will also partake in some of the recoveries. The news is clearly being shared on by the JP Morgan shareholders. The stock was up as much as 4.5% earlier today. It's still up about 3.4%. So net-net, people are seeing this as good news for JP Morgan. Clearly, the First Republic shareholders and bondholders appear to be getting wiped out. But will this cause any other broader issues? Perhaps not immediately, but I will leave you with one thought on that front is, long-term, is there any implicit risk in something like this where JP Morgan has to come in and rescue a smaller bank? What confidence does that leave with the other smaller banks out there when, for the customer from Main Street, it appears clear that the strongest and the safest and most viable bet seems to be to park your cash with the biggest banks in the country?
Hey, Sri, that's been a story the last 2 months. Thanks for being with us. Sri Natarajan there on the latest with JP Morgan and First Republic. Just get the feeling here, Lisa, there's no in-between.
Yeah.
There's no in-between now, and that we've just produced a template for the banking stress of the last couple of months, which is basically as follows. If a bank gets into some difficulty, wait a little bit longer, wait for it to fail, and then come to terms for a deal.
And then,
is that the template now?
Well, and this is really the risk, right? Because this is not what the FDIC wants to do. They were talking about bailout culture. They don't want to see it persist. They don't want to take $13 billion of losses. But this was their best option. And then there's the other side of this. What does this mean about the banking system where the biggest continue to get bigger and are actually rewarded for it by the U.S. government?
And that certainly wasn't the first move of the big banks in America. I want to be very clear about that. They did all band together and try and keep this bank together.
It's not their fault.
Try and restore confidence. Not their fault. Totally
Absolutely
on board
not.
with that idea. But based on what's transpired over the weekend, we spent 2 weeks saying, is someone going to step in? Is someone going to step in? I mean, there's no incentive to step in. There was an incentive to step in over the weekend, which is why there were some bids.
Well, yes. And then this also raises this issue of the biggest banks were regulated a lot more heavily than the smaller banks. People wanted the smaller banks to not have the burden, the cost of that regulation. How much do we have to rethink that at this point, even at the expense of some of their lending power?
Kathy, I've asked this question a few times, so I'm going to ask it again. And it's a little bit unfair of me, so you can take as much time to think about it if you want. The risk that Chairman Powell runs now, for months, in fact, for the last 12 months, we've been talking about the risk of him becoming Burns. Is the bigger risk now that he becomes Trichet and hikes at the most inappropriate time? Just think that through. Where do you come down on that one right now? Is it Burns or Trichet? What's the big risk for him?
I think it's Trichet, and have all along. I thought that this Fed was moving too fast and ignoring some of the lags between tightening monetary policy and what impact it has on the economy and on the financial system. And we've seen a lot of stress in the financial system in various ways, even before this. And so I think the risk is greater that they move too far, too fast, as they have, than having the Arthur Burns problem of having to tighten down the road. I don't think this is a repeat of the 60s and 70s. It's a very different economic environment.
Would you go as far as saying you don't think the inflation story is as sticky as some people might say it is?
Yeah, I do. I think we've seen the goods prices come all the way back down. I mean, oil prices are lower than they were pre-pandemic, so we've seen the supply side come back. And when you look at, balance sheets on consumer side are good. People spend money because they have jobs. But it doesn't look to me like that's necessarily a big push on inflation. We still have aging population. We still have demographic drag. We still have a lot of savings globally. So I'm not sure that we need to move as fast as they have moved.
Kathy, good to see you. I can't believe it's been like 3 years plus, but it has been. I don't know where that time's gone. Kathy Jones at Charles Schwab, thank you very much. And here we are 3 years later, Lisa, staring at 5% interest rates at the Federal Reserve and the fourth bank in the last 6 weeks going under.
And an economy that has been highly unpredictable. And I think that that's the unsettling backdrop, is that people just don't have a sense of what model to follow at a time when people are still disagreeing on whether we have a high interest rate environment going forward or a low interest rate environment going forward, and how quickly this disinflationary process really is going to take hold. And that, to me, is the great uncertainty behind the cascade of failures and problems that we have continued to see in the financial sector.
This word resilience comes up a lot, but I think we have to be really specific about what we're talking about. I think we might be talking about labour market resilience captured by a 3.5% unemployment rate. Can you say that about the equity market? Maybe over the last couple of months, but ask anyone who was long the NASDAQ last year whether there was equity market resilience in the face of the Federal Reserve. I think they might have something else to tell you.
No, I mean, there was a tech recession. That's what a lot of people are saying, and now we're getting the rebound of it. I think the consumer spending has been the issue that has been resilient, that has continued. But how long if the jobless rate does go up?
The conversation continues around the banking sector. Mayra Rodriguez Valladares of MRV Associates on the regional banks coming up a little bit later.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The nation's largest bank has become even larger. JP Morgan Chase has won the bidding to acquire First Republic Bank after it was taken over by regulators following bad investments and a run on deposits. JP Morgan says it expects to have a one-time $2.6 billion gain linked to the purchase. The lender will pay $10.6 billion to the FDIC. Regulators will provide $50 billion in 5-year fixed-rate term financing. In Sudan, the army and the paramilitary force that it's fighting reportedly will send representatives to negotiations. That's according to the Associated Press, which spoke with the UN's top official in Sudan. The two sides have extended a fragile ceasefire, but there were still reports of fighting. Philippine President Ferdinand Marcos Jr. says he's determined to forge an even stronger relationship with the U.S. Marcos meets with President Biden today at the White House. The Philippines has granted the U.S. greater access to its military bases, paving the way for an increased American presence in the region. New economic data shows that China's recovery remains patchy. The latest indicators point to a contraction in manufacturing. Still, consumers splurged as the country began a 5-day holiday, and the housing market continues to rebound. Pilots at American Airlines have voted overwhelmingly to approve a strike authorization measure. Their union would only be able to call a strike if allowed under federal labor law. The Allied Pilots Association and American remain in contract negotiations. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
From a business cycle perspective, we have had a pretty buoyant equity market this year, but I think these recession risks are still pretty material, and that means ongoing stresses in the banking sector are something we need to worry about.
Mike Dada, the chief economist at Roth MKM Partners, weighing in on the banking stress of the last couple of months. We have a deal this morning between JP Morgan acquiring First Republic, the government needing to step in once again and broker a deal between the two institutions. The stock is higher by almost 4% in the pre-market. Here's the response from the Treasury. A Treasury spokesperson saying this, Lisa: Treasury is encouraged that this institution was resolved with the least cost to the Deposit Insurance Fund and in a manner that protected all depositors. The banking system remains sound and resilient, and Americans should feel confident in the safety of their deposits and the ability of the banking system to fulfill its essential function of providing credit to businesses and families.
Yeah, well, this is a moment of incredible politics for them, where they have to somehow justify why it took so long and why they are still ending up on the hook for $13 billion of losses. And Mohamed El-Erian, who put out a column this morning, points out that this also consolidates power with J.P. Morgan. It is not what they want. It is so much less than ideal, and it took a long time with a lot of hemming and hawing and a lot of potential collateral damage that has been made along the way.
Can we pick up on that last line from the Treasury? Americans should feel confident in the safety of their deposits and the ability of the banking system to fulfill its essential function of providing credit to businesses and families. Follow-up question. On what terms will they fulfill the function of providing credit to businesses and families? On what terms in this banking system now?
Do they want them to have loose terms and then potentially fail? Or do they want them to have tight terms and then basically restrict credit to American families around this country? They're stuck between a rock and a hard place at a time of rising rates, inflation is a serious issue, and bigger banks consolidating their power on a multitude of layers, including their deposit risk and how much they have to pay depositors because they are perceived as the safest house in town.
We can catch up with Anne-Marie down in Washington, D.C. AMH joins us right now, our Washington correspondent. Anne-Marie, always good to catch up with you. Your reaction to how this has gone down, how it's played out over the weekend, and the response from the government this morning?
Well, the response from the government is pretty muted this morning. Again, you hear the Treasury Department saying the banking sector is sound and resilient. Yet, Jonathan, you keep reminding the public and our viewers that this is the fourth bank failure in a number of months. What is also interesting is the optics around First Republic. This is obviously a bank that had a lot of wealthy clients, and you don't see a statement coming from the White House that the president is going to give remarks before the opening bell this morning. That is what happened on March 13th when we had the failure of SVB. And the White House really wanted to make sure that the public knew that this wasn't taxpayer money, and they wanted to make sure they were doing everything possible to avoid the word bailout. It does seem that they're trying to really put this just as J.P. Morgan is dealing with this with the FDIC, because it's a hard moment for the Democrats, right? They, of course, don't want a bank to fail, but at the same time, this just makes J.P. Morgan bigger. They actually had to be able to rescue this bank. They had to get a special approval because how much the percentage of deposits they have in the United States. And this just means more bank consolidation, something Democrats don't want.
Hey, mates, let's talk about how we got here. Going back to the morning that you broke the news that Jamie Dimon and Secretary Yellen were having a meeting. Subsequently, that was followed up with $30 billion. Banks coming together in America and depositing $30 billion at this institution. AMH, did they ever think we'd end up here just a few weeks, a month or so down the line?
I don't think you'd have J.P. Morgan's Jamie Dimon coming to Washington, sitting down with Treasury Secretary Yellen, coming up with this plan to inject $30 billion to then get to this point. They thought that that would be the end of it. But really, what history now tells us is that was just a Band-Aid in this saga for First Republic, which now will open up when they open up their banks this morning, some 80 of those retail banks around the United States. It will now be you'll be banking with J.P. Morgan. They did not think this was going to happen. This is going to be a big topic of discussion this week. Particularly, we do have the House out of session, but the Senate is in session, and there's going to be a hearing actually on executives when it comes to bank failures. And just like you heard with SVB, just like you heard with Signature Bank, the debates are going to grow from Republicans and Democrats on whether or not there needs to be more regulation. You really just see the writing on the wall of where this is going.
Well, is there enough will in the congressional caucuses to actually regulate smaller banks more, even if it causes some of them to go out of business or be consolidated?
Well, we already know what the responses are going to be. What you saw from when the report came out last week about the failure of SVB, you had Senator Sherrod Brown talking about the fact that there needs to be more regulation. There should be an unwinding of the easing of those terms from Dodd-Frank from the prior administration, which, of course, was voted on, though, on a bipartisan basis. And then you had Senator Tim Scott saying that we are overregulated, and also that this is coming from the Biden administration because of higher inflation. That meant that the Fed had to hike rates at this aggressive pace, and that is why so many banks were caught on the back foot. These are going to be the type of tweets, statements, and rhetoric you're going to hear coming up, I'm sure, this Monday morning. But what also is notable, besides the Treasury statement, we haven't really heard from anyone else yet because it's quite early here in Washington. Not even sure everyone knows that J.P. Morgan has now bought this bank.
Okay, but on Friday, we got the postmortem to SVB from the Federal Reserve. Was that satisfactory to lawmakers? Do they feel like they got a full accounting of what went wrong?
I think they feel like they got a full accounting of it, but doesn't mean they're satisfied. They continually talk about the gaps, the fact that where was oversight, where were the supervisors. Both agree that there was a failure on the supervision. Republicans, though, think that the supervision, the regulations are there in place. They're just not using them the way they should be, appropriately. While Democrats say that actually we do need tougher regulation and we should be easing some of the terms we've had with the rollback of Dodd-Frank in 2019. So that's really where the division is. They do think that there's a failure on the supervision part and the regulators part, but what Republicans are saying is that enough is in place, they just didn't use it adequately, and Democrats are saying we need more.
AMH, thank you, as always, and that not-so-subtle dig at the rest of Washington didn't go unnoticed.
Being asleep?
Being asleep still at 7:50 in the morning. They haven't woken up. They don't realise this deal has been done. Well, it has been done. JP Morgan acquiring First Republic. Lisa mentioned that piece from Mohammed Al-Arian that came out moments ago on Bloomberg Opinion. He said JP Morgan First Republic will haunt US banks. The solution to regional banks' crisis raises more questions and concerns about the US financial system. That piece concluded with this paragraph here, Lisa. The US economy continues to suffer from too many years of easy money and the subsequent mishandling of the rate hiking cycle and lapses in supervision and regulation. Goes on to say, with that comes the ever-present risk of collateral damage and unintended consequences, given the first best policy responses are no longer available. The latest from Mohammed this morning.
This is the problem with being on the back foot in combating inflation. This is what happens when you're on the back foot after a regulatory regime that even the Federal Reserve itself described on Friday as being insufficient to get information to people who could actually act on it, even though everyone knew there were problems at Silicon Valley Bank. This is a real issue at a time when people already are losing faith in regulators to really be able to flag things effectively. And I really do wonder what this means going forward, especially at a time where so far people are fairly calm, at least based on market pricing.
Well, going forward from here, I think overwhelmingly the view is that this is a good deal for JP Morgan. Now, I have no idea where we're going to be in 6, 9, 12 months. I mean, you just don't know, do you? So it's easy to sit here and say, yeah, everyone says it's a good deal. It's a great deal for JP Morgan. We'll see. We'll see.
And it's not necessarily to say that it's JP Morgan's fault in any capacity. They actually stepped in. They did mitigate losses for the FDIC, as they said, as the FDIC said. This is an issue of power in the biggest hands. We are seeing that with banks. We are seeing that with corporations. How much does that really push against what lawmakers want to see, which is an ecosystem that's healthier with smaller components that are healthy and sustainable?
Although I do love this line from Jamie Dimon. Our government invited us to step up, and we did. And then at the same time, RBC's coming out and saying, overall, we view this as a very positive transaction for JP Morgan. I mean, it can be both. It can be both, of course. It's just PR requires you to lead with one headline and not the other, I guess.
It can be both, but could it have been both for anybody else? And the idea that only the biggest and most powerful could have benefited in the same kind of way in consolidating this with a guarantee, with a socializing of the losses taken on by the FDIC will raise a lot of concerns and set a moral hazard that still has that potential for collateral damage, as Mohammed was saying.
That stock is up by close to 4% in the pre-market. JP Morgan rallying just a little bit of a pop going into the opening bell about 94 minutes away. In the next hour, Vishy Tirupattur of Morgan Stanley. We'll catch up with him in just a moment.
Ultimately, this is about building confidence, and I think you build confidence, A, by having First Republic resolved, and B, by seeing that a very good operator who has strong capital.
If you look at that index, that banks index, it's been trying to stabilize. It's remarkable the resilience that we've seen.
Recession risks are still pretty material, and that means ongoing stresses in the banking sector are something we need to worry about.
Our guess is the market will probably grind lower over the next 6 months.
The normalization, I don't think, is going back to zero rates and the same sort of environment.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
JP Morgan winning the bidding to acquire First Republic Bank from New York City this Monday morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Your equity market on the S&P 500, negative 0.1%. We have to start the week with this one, Lisa, going into the Fed on Wednesday. Another bank in America, essentially, effectively failing.
The second biggest failure in America's history. And this comes, just as you pointed out, a month after Silicon Valley Bank's failure. The question here is how much more is there and what kind of path does this set in terms of what an agreement, I don't want to call it a bailout because that's loaded, what an agreement of this nature looks like.
The second and third biggest bank failures in U.S. history have come in the last 6 weeks, Lisa. The last time we got one, the Federal Reserve followed up a week or so later with a rate hike. And now seemingly the Federal Reserve is going to follow this one with a rate hike. And a lot of people will come on this program and say they're different issues. And that was idiosyncratic. And they've got an inflation problem. Do we need to talk about something different?
People are saying that it would be idiosyncratic. It would be two separate issues if the regulatory side of the Federal Reserve were perhaps a little bit more on top of things and reflecting where risk was. There now is this question around whether we're actually getting accurate representation of whether they are overseeing the risk. And I think that is one of the concerns going forward that will underscore some of the uncertainty that we hear from a number of guests that have already been on this morning.
My issue with this is that events like this are always unique and idiosyncratic in nature. The problem is when you have more than enough of them, they become a broader problem. So you can sit here and say SVP idiosyncratic. Okay, great. You can say it about Signature. You can say it about Silvergate. Said about Credit Suisse because we've been dealing with that one for years. And maybe you can say the same thing about First Republic, but once you add it all up, don't you have a broader, bigger problem at the end of the day?
It doesn't look like 2008 enough for people to say it's going to be a financial system meltdown. And I think that's the reason why some people are pushing back and saying, well, it's not going to be 2008 because the big banks seem completely fortified. That said, there is going to be, and we've been talking about this extensively, this tightening in credit, if not more bank failures themselves. And who takes it on? Is this basically the template now that a big bank who has an incentive will come in, get the losses taken onto the balance sheet of the FDIC, and will go forth and make more money and consolidate their power?
Imagine at the start of 2022, people were long the NASDAQ, and I said things could get really bad here, and they would turn around and say, well, it's not 99, 2000. I'd be like, okay, cool, it's not a crisis, great. Do you think you're going to have a good 12 months off the back of this? And then tech stocks get hammered. That's my frustration. Whenever there's a difficulty in the financial system, that you get a lot of people coming on programs like this saying it's not 2008. Okay, it might not be 2008. I'm totally on board with you. I get that. The likelihood that it's something that large, that systemic, that broad, I understand all of that. But that doesn't mean it's good. It could mean there's something in between here, between it's not an extreme case, boom, scenario, crisis kind of thing. Could be something bad still.
Let's build on that, because perhaps the biggest banks took the lesson from 2008 and got completely fortified and heavily regulated in building up some of their asset books. Almost too conservative, people saying. Utilities, they said. Not profitable enough, they said. And now they are in a position to consolidate power, and the regional banks that were more lightly regulated are the ones that are running into issues. This is a huge challenge for the entire system as it was created post-financial crisis in 2008.
Herman Chan is in charge of covering these banks for us, regional bank analyst at Bloomberg Intelligence. Herman, we caught up with you earlier. It's great to catch up with you again. Yes. You've had some more time to go over this deal. Mm-hmm. Great deal for JP Morgan.
Great deal for JP Morgan. Great deal for the government. Could have been worse. So overall, I think you could say those two are the winners.
Idiosyncratic?
I agree with you in terms of there has been a few banks now that have failed. So you can't say it's largely idiosyncratic. I think the reasons why these three banks failed is that they were growing way too fast. They underappreciated the interest rate risks that were adding on the asset side of the balance sheet, and they underappreciated the nature of the deposits that they were bringing in to grow the assets during the pandemic period. So the other regional banks that we cover don't really have that systemic risk on the deposit side. So they should be more insulated.
Urban, can these smaller banks withstand a regulatory regime akin to what we see with the bigger banks?
Well, based on what we know now from comments from Michael Barr and other regulators in terms of what's coming next for banks with $100 billion in assets or above, it seems reasonable that they can absorb these hits. It will require more capital, more liquidity requirements, potentially more debt on the balance sheets. But this will all be more of a hit to earnings on the margin, but nothing that would be too tough to absorb.
How much consolidation do you expect in the wake of some of this regulatory action?
Yeah, that's a good question. It seems like the regional banks need to get stronger. And what's a hindrance is that the regulators have been much more reticent to approve deals. And we've seen that recently with TD's bank, with TD trying to acquire First Horizon in Tennessee. That deal's been delayed. U.S. Bank acquiring MUFG Union in California. That deal was delayed for a while as well. So if the regulators want stronger regional banks, they need to signal to the industry that they're more willing to let strong banks acquire and get tougher on that front.
That media call started in the last couple of minutes that JP Morgan is hosting. We're hearing from the CEO, Jamie Dimon, and the CFO. The CFO is saying this: we did not seek out this deal, but it does have benefits. Deposits bought time. Now it's an orderly resolution, referring, I assume, to the $30 billion that was placed at this institution where JP Morgan and other banks banded together and deposited that cash there. First Republic advisors will be part of JP Morgan Wealth Management. So we're getting a decent idea, Lisa, now of the structure of the arrangement once this bank effectively has been absorbed by JP Morgan.
You put it well, too. You could tell underneath some of these comments how they're trying to be very delicate. We didn't seek this out. Don't blame us for having any benefit of this. We're protecting our shareholders. It does have benefits, but this was not our fault. And you can feel that in all of the comments as they explain the benefits and the loss-sharing agreements.
Not just feel it, you can hear it in the words of Jamie Dimon in that initial statement.
Yes.
Our government asked us to step up.
Right.
So we did. I understand all that. I actually don't think they need to go out of their way this morning to say big things about how good this deal will be for them, because I think a lot of the South Side this morning is going to do that for them. This is from Jamie Dimon right now. The First Republic deal has not changed the odds of a recession. The First Republic deal will help stabilize the system. I'm not sure, because I'm not listening directly to this call, obviously, whether that's a response to a question just yet from anyone in the media. If they're asking about recession odds from Jamie Dimon on this call, I'll go insane. Ask him about the deal, not the recession odds.
Honestly, I think that at this point, the focus is less on JP Morgan and more on the regulators and what they plan to do to prevent this from happening again, and whether this is actually the template going forward for other banks that are in the same kind of situation, John.
The deal will help stabilize the system. The latest from JP Dimon of JP Morgan as that media call is ongoing. I'll bring more headlines from that. In about 22 minutes, we'll get the investor call as well. So maybe the nature of the Q&A might be a little bit different to what we're hearing here. I want to bring in the analyst Vishy Tirupatur from Chief Fixed Income Strategist at Morgan Stanley. Vishy, just to bring you in on the back of some of these headlines from Jamie Dimon that the First Republic deal will help stabilize the system. I won't ask you directly about this combination, Vishy, because I know you can't answer that question directly. I do want to understand from you, though, whether you get the sense, based on the information, the data you're getting from the Federal Reserve, as to whether the system is stable, things have stabilized.
If we step back and think about where we were before the weekend and over the weekend, things have moved in the right direction. But I would look at the borrowing from the facilities, from the discount window and the bank term funding program. The borrowing from those two facilities went up for the last 2 weeks. And I would look to this week, how much of that will come down as a consequence of this particular deal. But the fact remains, there is still a fair amount of stress in the banking system, as evidenced by the need to borrow what would be a significantly negative carry borrowing from the system. So that's how I would look at it. Are we better off today? This resolution is clearly a positive, but the fact remains that there has been stress in the system, and we would look to the dependency on the borrowing facilities to get to measure how much the stress in the system remains.
Vishy, I'm struck by how much is being done to avoid fire sales of assets, liquidations of portfolios that have lost value significantly. At what point do you think that we're actually going to see some of these liquidations as we see banks and other institutions run into issues?
I think there's a good case study now with the liquidation that the FDIC is doing with mortgages, what is predominantly mortgage-backed securities, agency mortgage-backed securities. This is going to weigh on the mortgage market. How, even though this is being done orderly, this is not being a fire sale, it will be stretched over multiple months, but this is going to weigh on the mortgage market. To put some numbers there, our expectation of net issuance of MBS this year, before all of this happened, was 150 billion. And this particular liquidation that the FDIC is doing itself adds incrementally another 100+ billion. So that kind of a I would say supply would mean that the significant repricing is needed, which is why we are underweight mortgages at this time.
Just more broadly for high yield credit, Vishy, where do you want to be if unemployment's going to go from 3.5 to 4.5 in the way the Federal Reserve anticipates? Is that an environment where you want to be long credit?
I think you want to be long very high quality credit. It is not a time to go down in the credit quality. It's not. I think we would stay in the sort of single A type of investment grade, shorter duration investment grade credit. We think there is still value there. That's where we would like to be.
Vishy, wonderful to get your perspective. It always is. Vishy Tripatur there of Morgan Stanley. The latest from this JP Morgan call from the CFO. This is a very, very different situation from 2008. From Jamie Dimon, we will see some reduction in bank lending with the First Republic deal. It's an interesting line that we can build on. We'll do that next with Maya Rodriguez Valladares of MRV Associates. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. As you've heard, JP Morgan has won the bidding to take over troubled First Republic Bank. The FDIC ran the sale after private rescue efforts failed to make up for bad investments and a run on First Republic's deposits. And that deal will make the country's largest bank even larger. JP Morgan will pay $10.6 billion to the FDIC. Meanwhile, regulators will provide $50 billion in 5-year fixed-rate term financing. House Republicans are challenging the Senate to pass its own debt limit bill. They're trying to increase pressure on President Biden to hold talks on spending cuts they've linked to an increase in the U.S. borrowing limit. The president has insisted the two topics shouldn't be connected. The U.S. runs the risk of defaulting on payments as soon as June. Tim Scott is teasing an announcement later this month on his expected run for the White House. The Republican senator from South Carolina says that he'll have an announcement on, quote, the final step May 22nd. Scott has already set up an exploratory committee. In Canada, about 120,000 government workers have ended a strike that began April 19th. Prime Minister Justin Trudeau's government agreed to wage hikes of about 12% over 4 years. About 35,000 workers for Canada's tax agency are still on strike. Japanese drug maker Astellas Pharma has agreed to acquire Iveric Bio for about $5.9 billion. Iveric, which is based in New Jersey, develops drugs to treat age-related blindness. The deal will be funded by cash and debt. The price represents a 75% premium to Iveric's 30-day average through the end of March. Global news powered by more than 2,700 journalists. I'm Lisa Mateo. This is Bloomberg.
The resolution of First Republic should be idiosyncratic from my viewpoint, and I would think that the group could see a little bit of a relief rally because of this, but looking out over the next 3, 6, 9, 12 to 18 months, the banking group does have a lot of headwinds facing it.
David Chiaverini there of Wedbush weighing in on the banking situation following JP Morgan's acquisition of First Republic. JP Morgan's C-suite, Jamie Dimon, together with the CFO, on a call right now with the media. Just moments ago, Jamie Dimon saying this is nothing like 08 or 09, going on to say that the system is very, very sound. On banking failures, he had this to say: this is getting near the end of it. That's the latest from the JP Morgan CEO. In the pre-market, Lisa, that stock, I think their session highs, it's up more than 4%.
They also said this was a highly competitive process in terms of trying to get all the bids. You wonder what the other terms were of the, say, Bank of America's and Citigroups that were in the room as well. This, to me, though, is a real question. How do they have visibility saying this is getting near the end of it? How do they have the information to say that at a time when they are not the oversight agents of the government? Do they have some kind of sense that perhaps we don't?
And this is the media call. In about 10 minutes or so, maybe 15 minutes away from now, you'll get an analyst investor call as well. So you're going to get a ton of headlines from JP Morgan's Jamie Dimon over the next 30, 40 minutes or so. Joining us on some of these headlines, Myra Rodriguez-Valladares, Managing Principal at MRV Associates. Myra, wonderful to catch up with you again. Just working through this together over the last few weeks has been a pleasure for all of us here on the show. Can I just get to that headline from Jamie Dimon that on banking failures, this is getting near the end of it? Do you get the sense that this is anywhere near the end of it?
Respectfully, I'm not sure that I agree. What is not idiosyncratic here is we're discovering that, unfortunately, a lot of these banks are not very good at interest rate risk and liquidity measurements, which really is what should be astonishing. This is the basics of banking. And as long as the European Central Bank, the Bank of England, and of course the Federal Reserve continue to raise rates, I'm afraid that this turmoil may not be over yet.
Myra, do you think that the regulators' models effectively account for interest rate risk, given that they were not able to get ahead of some of these cases?
You know, they actually do. And one of the things that has really come out since Friday with the Federal Reserve reports as well as the FDIC reports is that a lot of problems, for example, with Silicon Valley Bank and Signature were actually identified by the regulators. The problem was the enforcement. And there have long been many, many requirements for banks to measure interest rate risk. The problem is, unfortunately, with every new crop of risk managers and lenders, they always think that this time is going to be different. They don't pay attention to the history, that interest rates go down and they also go up. And you need to constantly be testing your asset liability measurements, all your different kinds of models for interest rates going up and down. So this idea that people have been caught by surprise, they didn't realize that interest rates could go up, is really truly astounding.
One thing that Jamie Dimon did say was that there would probably be some reduction in lending on the heels of their acquisition of this bank, First Republic. What's your sense of how many smaller banks are going to get acquired? How much lending is going to get taken out of the system if there are more potential incidents just like this?
Yeah, I am worried about some of the smaller banks, even some of the community banks, some of the smaller regional banks. It's hard to compete with the incredible advantages that a JP Morgan, Bank of America, Citibank have. These are globally, systemically important banks. It's not just their size, it's just the diversity of the different businesses that we have. And here we are, 2023, and it almost feels, at least from the history books, that we're kind of back to 1895 with JP Morgan rescuing the American government in 1913 when JP Morgan was rescuing banks. That kind of bank has become incredibly powerful. So it now has incredible exposure to operational risk. What kinds of skeletons are going to come out with this acquisition of First Republic? We really need to keep an eye on those kinds of things.
Anne-Marie joked about 30 minutes ago that Washington, D.C. was still asleep, wasn't awake yet, and hadn't seen this deal. And she messaged me a moment ago and said it looks like people are waking up. Senator Warren on Twitter in the last, I think, 20 minutes said this: the failure of First Republic Bank shows how deregulation has made the too big to fail problem even worse. A poorly supervised bank has been snapped up by an even bigger bank. Congress needs to make major reforms to fix a broken banking system. Myra, what's broken about it? And what kind of follow-up are you expecting after this stress of the last couple of months or so?
Well, one thing that is definitely broken is that after all the time that legislators and various lobbyists spent with Dodd-Frank, there's a good portion of Title I that was actually gutted, where banks the size of Silicon Valley or First Republic were no longer considered systemically important. That's incredibly incorrect as we've seen this. And it has very significant repercussions to the entire financial industry, as well as to Main Street. Think of all those people who are now getting hurt and are going to be losing their jobs every time that one of these banks fails. So you need to declare these banks systemically important. That then means that they would get enhanced supervision. They would have to do a better job of measuring liquidity risk, especially doing simulations of periods of stress, which is what they should have been doing all along. And so there is an element of truth that there is deregulation. However, you also need to provide the examiners and all the different kinds of supervisors with resources. They don't have enough in terms of manpower, in terms of human resources, and they also need more resources in terms of technology to be able to better detect when some of these risks are percolating with the banks. And you need to fire executives and high-level risk managers when they don't do their jobs, and there definitely need to be clawbacks. All these executives are walking away with millions, and what about everybody else at the bank and in the surrounding community that is going to lose their job?
What about firing regulators?
That's right. If indeed there's a good postmortem and we discover that there are any kind of professional in the various state as well as the national regulatory entities that aren't doing their job, they need to be fired. And part of the problem is the tone at the top. The way that things were, let's face it, former President Trump made terrible appointments. The tone of the top then filters down, and it very much became both to off-site and on-site examiners to have hands off and to almost be friendly with the banks. That's not what we want. We want examiners, both on-site and the off-site supervisors, to be empowered to not only talk about what the problems are at the banks, but then you need enforcement. All of the treasure trove of documents that was released on Friday shows that those examiners were on top of things. It was the enforcement that completely lacked, sadly.
Was Chairman Powell a terrible appointment?
That's a very interesting question. I think that he has done a very, very good job in very difficult circumstances with monetary policy. That is where his background is, where his expertise is. His background is not in bank regulation, bank supervision, bank examination. These are interrelated, but they are different things. I think that somebody like Lyle Brainard should have been appointed to head the banks earlier during the Trump administration. When I say head the banks, I mean the bank supervisory part. Obviously, I think that Mr. Barr has been a good appointment, but he barely got there. So there's a lot of different parts to the Federal Reserve. And Ms. Chair Powell's background is not in supervision and examination. Former Chair Tarullo was fantastic. Unfortunately, he never got the official designation. So there are some talented people there, but they were not put to head bank supervision when they should have under the previous administration. And those things take time, and they're all surfacing now. So there definitely has to be a serious postmortem about what needs to be done about both state as well as the national agencies.
Mara, thank you. Mara Rodriguez Valladares there of MRV Associates. I didn't hear Qualls' name there. You didn't either, did you?
She was going through every single person, but not the vice chair for supervision during that period.
Interesting on Chairman Powell. I mean, some people would not give him a ringing endorsement on monetary policy. Would they?
Yeah. I'm thinking Mohammed Ali in particular, basically saying.
Oh, look, I just had Mohammed's voice in my head, just saying, no, just no.
I know. He's made his voice known, and a lot of people would agree.
Michael Kushman, Morgan Stanley, Cameron Dawson, New Edge, Michael Contopoulos, Richard Bernstein, Advisors, Erica Nigerian of UBS, all coming up in the next hour on Bloomberg TV.
Very interesting Monday as we find out that JP Morgan has agreed to acquire all of First Republic with a guarantee, with some sort of loan loss sharing agreement with the FDIC. This comes amid great uncertainty, a huge week ahead with the Fed meeting, the ECB meeting. On Thursday, we get Apple results. Tomorrow, we get JOLTS data. And of course, on Friday, we get payrolls coming out. We've got JP Morgan shares up 4.3% on the heels of a deal that pretty much everybody is saying is beneficial for them based on how much more they're going to get in terms of clientele for the wealth management unit. People are saying it's going to be about $500 million a year of interest payments that they will receive from these assets. We will dig into that in just one second. In the broader market, we are seeing stocks a little changed. We are seeing a little bit more action in the bond market, yields a bit higher, prices lower, especially as there are a number of bond deals that have gotten kicked off, including Meta, that is selling a 5-part deal, including a 40-year piece. So there's a bunch of issuance, which is pressuring things. A bit of dollar strength, euro at 110, and we are seeing a bit of weakness in crude, $75.16. A big question here is how much some of the weakness is going to be driven by what we're seeing with tightening lending standards in smaller banks. We are hearing the call with JP Morgan has just wrapped up. We are waiting for the media call where they're going to take questions. Sonali Basak, Bloomberg Wall Street correspondent, joins us from Los Angeles, where she is there for the Milken Conference. Sonali, you've been watching and listening to what they have been saying so far. What stands out to you?
What stands out to me is that JP Morgan won this auction in the first place. Now, remember, Lisa, this is a pretty remarkable process to begin with. When I talk to my sources, this has been done before, where they have reached out to smaller forced acquisition of smaller banks before a resolution, but never a bank of this size. Now, for JP Morgan, remember, they already have more than $1 trillion worth of loans, more than $2 trillion worth of deposits. So does it make them much, much bigger? Compared to their asset base, it is somewhat limited. However, this is still one of the largest bank failures in American history. It is a large acquisition still for JP Morgan. It is something that they had to get approval from their regulators in order to do, given that they already hit kind of the deposit limit here that was preventing them from otherwise buying a bank of this size. However, the reason this has happened is because by doing so, by allowing JP Morgan in this auction process to buy this bank, the idea here is that this bid is what would reduce the cost to the deposit insurance fund. Now, the politics from here will be interesting to watch. Something that was unclear from the beginning was whether a systemic risk exemption would have been used in the failure of First Republic, which is why there was such a hurry behind the scenes to get something done and get something done orderly. And remember, from the last couple of weeks, we had a lot of learnings from other failed banks and how those processes had played out in order to make this one swifter, faster, although I know that watching from the market, it seemed like it took weeks to get something like this done.
The media call just finished. The analyst call is going to be starting just shortly. I'm wondering what questions a lot of people have for JP Morgan about this deal, perhaps about the insight that they have in saying that this is pretty much near the end of it when it comes to some of the distress in the smaller banks.
Well, listen, the market likes it. And I think one thing that JP Morgan had done here to kind of stem some of the fallout was two things. One, this is a deal that is closed. It is done. It is seal, signed, delivered. The other thing about this deal is that they're paying back the deposits to the other firms. Now, you know, does it heal the safety and soundness of the financial system? JP Morgan is unlikely to do a deal like this twice. What happens after this? The fact that the systemic risk exemption was so unclear up till this point, I think that leaves a big open question, Lisa, about what would happen if more banks were to run into trouble. There's a roadmap now on how to resolve these issues. But again, if this were to happen again, what is the saving grace when we know that this took weeks to settle out?
Sonali Basak, thank you so much for that insight. A roadmap for the path ahead when there is another situation like this, which includes the potential for less lending, which includes a potential risk to community banks that do run into trouble. And this does raise some questions for the Federal Reserve, which meets tomorrow and Wednesday, coming out with a decision on how much more to tighten monetary policy, raise rates in the face of ongoing weakness. Joining us now to really give a sense of what the risk reward is for a Federal Reserve, the balance of risks at a time of inflation that is coming down but still incredibly high. Joseph Livornia, Chief U.S. Economist at SMBC Nikko Securities. Joe, wonderful that you're joining us here on set. I'm wondering, from just a high-level perspective, what is the impact on the economy from failures of banks that have left the biggest banks in America,
even
assuming
bigger,
the smaller ones even bigger, and not going to fill in some of the lending?
There are two key things, Lisa. Number one, this problem resides with the Federal Reserve. Management issues exist in banks, no question. But this Fed raised rates much more than the forward guidance suggested. They put those rates way above where the market suggested last last summer they were supposed to be based on the inversion of the yield curve. And the banking system, the lending system doesn't work when you have a higher short rate versus the longer rate. The yield curve, not just as a predictor of recession, but causes recessions. And the sad thing is the Fed is going to now regulate these smaller and medium-sized banks when it was Fed policy itself that caused this crisis. That's number one. Number two, given the tightening in lending standards we saw in January, before this SVB, Signature Bank, First Republic situation rose, banks were already tightening lending standards, small, medium, and large banks at the fastest pace since previous recessions. So I can imagine that when we get the data a week from today, on Monday, May 8th at 2, it's going to show further tightening in lending standards, and that is unambiguously bad for the economy.
So you just said a number of things that I want to dig into, and I'll get to the Fed's and sort of how quickly they raised rates in just a minute. But if you're saying that they raised rates so quickly that the banking model did not work, then what kind of follow-on effect do you expect in other regional banks, even though a lot of people say they have been fortified, they have raised capital, they have addressed some of the issues?
Well, that may be true. So there's two issues there, Lisa. One is systemic, like how many other banks perhaps are behind the banks that have had troubles. And we don't know the answer to that. The Fed has backstopped these banks through these various lending programs. The issue, though, is will these banks make loans and extend credit? That, to me, is unlikely to happen. In other words, they're going to call in deposits or call in loans, try to raise deposits. Revolving lines of credit won't be extended. That's bad for growth. So whether there is another systemic issue because of, let's say, bank mismanagement, we'll call it with quotes, is sort of irrelevant in the sense that what the Fed's already done from a monetary policy transmission mechanism is they basically killed credit and money and lending creation.
So you don't think that it was the issue of Randy Quarles for not necessarily enforcing some of the regulatory oversight that the Fed flagged at specific banks that have run into trouble?
No, I mean, that's just political cover. I mean, if you looked at the bond market, through April of last year, it was the middle part to longer part of the curve. Those bond market returns at that point were the worst returns you had in measured history. So the market was not, people did not expect the Fed to keep going in 75s. And it was after that first 75 when the yield curve inverted. And the Fed stupidly ignored it.
Okay, but then what would you say to people who point to the actual economic data that's coming in that's been stronger than expected? Consumers keep spending. There has been ongoing credit creation. This morning we have 10 different issuers ready to sell corporate debt, even though rates have risen so much. What would you say to people who say the economy has proven that it is resilient and has been able to withstand this and then some, and actually it hasn't driven inflation down enough?
Inflation's lagging. Inflation's coming down. If you look at the symmetry of the CPI, the upswing and the downswing has been identical in this cycle. There are pockets of the economy that are strong. We had the same debate, Lisa, back in 08. I remember vividly, I wrote a piece on this. You look in 08, we had people debating if we'd entered recession. The economy grew over 2% in the second quarter of 2008, and what turned out to be the deepest recession since the 30s. So the fact that the data are all in alignment is normal. Where housing's in recession, manufacturing's in recession, inflation's coming down, core CPI will be sticky, rents are a big piece, but we know the housing's weakening. What is so wrong in just waiting and seeing what happens for the spillover, if any, in the rest of the economy? The Fed could have done that numerous times over the past year.
Well, they've gotten it wrong, though.
They've gotten it totally wrong.
Right, and they got the transitory concept wrong as well. And that some people would argue, including Mohamed El-Arian, that was the reason for how rapidly they raised rates. That yes, perhaps they did raise them too quickly, but that was the least worst option after not raising them for as long as they did. So what would you say to that? I mean, was the first misstep and the real misstep not raising them back in the summer of 2020?
Absolutely. Jay Powell channeled his inner Paul Volcker when he wanted to be reappointed. So you're absolutely right, and Mohammed's right about that. However, you don't correct one mistake by making another mistake. And I could imagine the people who have been arguing the Fed to raise rates, who have got to get inflation down. What happens, Lisa, hypothetically, we go into recession this year, as I believe will happen, and we're in next year presidential election year. What kind of political pressure is the Fed going to take? Because it doesn't matter who's arguing. It's one side's going to be happy they're cutting or not cutting, or whatever it might be. So the Fed has really put a huge bullseye on its back, and it could have been prevented. And part of the problem is that the Fed, all these meetings, it's all this unanimity. There should be debate. Economists don't agree on anything except for those at the Fed.
This is something that people are expecting we'll hear perhaps more of going forward. But right now, given where we are, given how quickly they've raised rates, what is the bigger risk? If they pause at this point, Is that the right course of action? Is it
Yes,
to cut at a point when people are concerned that they're going to reignite some of the credit creation?
Inflation is easy to handle. You raise rates. The Fed should have paused a while ago. The Fed will be cutting and should be cutting. Break-even inflation, the yield curve, the dollar, commodity prices, none of these things have been suggesting for the last 6 or 7 months there's really any sort of inflation problem. Not that inflation's needs to come down. It will. But the Fed should stop this crazy policy of tightening, and they should continue with the balance sheet, but they should cut on the rates.
That should. People are expecting, the market is pricing in a 25 basis point rate hike at Wednesday's meeting. Based on that rate hiking cycle, based on what you're seeing in the fundamental economy, what do you think will be the outcome for the U.S. economy?
Recession by the third quarter of this year. I mean, the thing is, if you look at the index leading indicators in the 06 period, it peaked 21 months before the economy peaked. That would put an economy peak this year in September. We're down almost 8% over the past 12 months. Virtually all the indicators are declining. The yield curve is still inverted. You mentioned the bank lending. That tightening is still working itself through the economy. Why in the world are you raising rates? You're actually making the problem worse because you're lifting money market rates, which is encouraging to record deposit flight. It's like, I don't understand why these people don't see it. It's kind of like remember in Zoolander with Will Ferrell, the
Yes.
Mugatu and piano key necktie, like the Fed. Those short rates, those bill rates are up at 5% plus. You've put them there. What are you doing?
Never thought that I'd hear Zoolander cited as a model for Fed policy. Joseph Livornia of SMBC Group, thank you so much for being with us.
Thank you, Lisa.
A wonderfully spirited discussion, and certainly the market does expect rate cuts to really start with a policy rate that, yes, goes up to 5.1%, but comes down to 4.3% by January of next year. Coming up, someone who advises on the oversight of some of the home loan banks, Mickey Shemi, principal advisor at the Federal Housing Finance Agency. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The nation's largest bank has become even larger. JP Morgan Chase has won the bidding to acquire First Republic Bank after it was taken over by regulators following bad investments and a run on deposits. JP Morgan says it expects to have a one-time $2.6 billion gain linked to the purchase. The lender will pay $10.6 billion to the FDIC. Regulators will provide $50 billion in 5-year fixed-rate term financing. Donald Trump is seeking a mistrial in that civil sexual assault case in New York. The former president's lawyer says Judge Lewis Kaplan's ruling have been unfair and prejudicial. The lawyer also wants greater latitude to cross-examine the accuser, E. Jean Carroll, when she returns to the witness stand today. Philippine President Ferdinand Marcos Jr. says he's determined to forge an even stronger relationship with the U.S. Marcos meets with President Biden today at the White House. The Philippines has granted the U.S. greater access to its military bases, paving the way for an increased American presence in the region. In Sudan, the army and the paramilitary force that it's fighting reportedly will send representatives to negotiations. That's according to the Associated Press, which spoke with the UN's top official in Sudan. The two sides have extended a fragile ceasefire, but there were still reports of fighting. And pilots at American Airlines have voted overwhelmingly to approve a strike authorization measure. Their union would only be able to call a strike if allowed under federal labor law. The Allied Pilots Association and American remain in contract negotiations. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Problem children in any crisis have to settle down before the market can settle down itself. And I think that if you look at that index, that bank's index, it's been trying to stabilize. It's remarkable the resilience that we've seen. We know that earnings revision trends in small cap financials, which is a good proxy for regional banks, have been absolutely smoked. And that's something else that we really need to see happen in here before I think the market can be content.
Lori Cavacina, head of U.S. equity strategy at RBC Capital Markets, trying to game out what the fallout might be, given the development that we've seen at First Republic Bank with J.P. Morgan stepping in, purchasing this bank despite having to overcome a hurdle of having already owned 10% of the deposits, accounting for them, and needing special regulatory approval in order to complete this. We are looking at markets that are a little changed as people assess this, also waiting for the Federal Reserve, which is going to come out after a meeting that starts tomorrow on Wednesday with an expected 25 basis point rate hike, then followed by the ECB. We have also on Thursday Apple earnings and on Friday a payrolls report. All of this amid a swirling uncertainty of how much further we will expect to see the fallout of regional banks running into distress, of what credit risk looks like at a time of rising rates for some of the most rate-sensitive areas, which brings us to our next guest, who has an incredible background understanding just that, risk and trying to game out that versus a rate hiking cycle. Someone who is at an agency that oversees Fannie Mae and Freddie Mac, Michael Shemy, principal advisor at the Federal Housing Finance Agency, which also helps set some of the rates that go into mortgages. Before we get into just the mortgage rate setting, I want to get your sense of whether the home loan banks have the wherewithal to withstand all of the lending that they have ongoing to some of these banks at a time when we don't understand the intersection between interest rate risk and credit risk incredibly well.
Well, thank you for having me. I would first say that FHFA oversees the GSEs. That's both Fannie Mae and Freddie Mac on one side of the house, and then the FHLB system on the other side of the house. We can say about the FHLB system is that obviously FHFA is closely monitoring all the developments over the last couple months in the banking turmoil, I guess we could call it. But predating this entire news cycle around the regional banks, FHFA initiated a comprehensive review of the whole FHLB system last year. It's called FHLB at 100. As the whole system approaches the centennial, FHFA, under the leadership of Director Sandra Thompson, wants to make sure that this system is really fit for purpose for the 21st century. We just completed the comprehensive public outreach portion of that review, and I think the next steps are, in the coming months to formulate final findings and formulate some recommendations. I think this FHFA leadership has been clear that sort of accepting the status quo is probably not a preferred result.
Right now, we're talking about the potential workouts for some of these banks, and we just had Vishy Terabatur on of Morgan Stanley, who was talking about the potential for forced mortgage sales. How do you account for this type of market action in what appropriate rates are for mortgages?
The GSEs, provide a lot of liquidity to the national mortgage markets, and we all benefit from that. What they don't do is control the interest rate cycle. So, you look over 2022, mortgage rates, went up by 400 basis points. Then they went down by 100 basis points, and they went back up by 50 basis points. The GSEs, FHFA, we don't control any of that. What we want to make sure is that all these regulated entities, whether it's Fannie Mae and Freddie Mac or the FHLB system, have the tools at their disposal to manage this environment, to be able to successfully continue provide their mission. And I think that's what we're squarely focused on.
You've recently come under some heat. The Wall Street Journal has written a number of editorials, including over the weekend, where they basically said that there are some changes that your agency has made that take effect today that raise costs for some good credit borrowers, and they make mortgages cheaper for low-income borrowers. Basically, that the rate-setting policy is being driven by a desire to make it easier for lower-income individuals to buy houses at the expense of higher-income individuals. What is your sense, and what is your response?
Right. So Fannie and Freddie remain in conservatorship. As a safety and soundness regulator, again, FHFA wants to make sure that the GSEs have all the right tools to continue meeting their mission responsibility, their market role, and continue to build their capital resources. And to that end, we've been public about conducting a comprehensive review of the GSE's mortgage pricing framework. That is, the fees they charge for guaranteeing mortgages on their books. The old framework was stale. It hadn't gone through a comprehensive review for some time. And over the last 18 months or so, we've made a series of steps to update the framework. And some fees have gone up, some fees have gone down with the latest iteration of pricing announced in January. And in our minds, this is a big step forward in enhancing the risk-based pricing framework. And it actually gave us the opportunity to sort of eliminate a lot of obsolete oddities that existed in the framework that had prevailed. Now, we announced this back in January. These fees have been rolled out in the interim by the industry. So I think it's sort of strange and somewhat telling that some misinformation now is only emerging that the GSEs are somehow penalizing good credit scores to subsidize bad credit scores. It's simply not the case. Good credit scores will still lead to better pricing, and the objective is really not to subsidize bad credit scores.
Well, the politicization of this highlights how fraught the moment is, given that some people are going to see increases of hundreds, if not thousands of dollars in their rates every month as a result to any change that we see. And we see a lot of changes in mortgage rates going up. And I'm just wondering how you assess how to accurately fortify some of these agencies at a time when, if rates go up too high or if the fees are too high, you're basically making it difficult for people to be able to pay back.
So that's certainly top of mind for the agency and for this pricing work. There are a couple things I would say. First of all, I think a lot of the criticism around this and some of the misinformation that's been, as you described, weaponized around this really anchors to the old pricing framework rather than looking at the absolute levels of the new pricing. And all these things have to be looked at holistically. We've taken a series of steps, and even in the January announcement, there are 6 new grids. There are a lot of things going on, and I think people are focusing on one particular cell combination in terms of pricing to sort of fit a broader narrative, which is not true. What I can tell you, though, Lisa, is that we have been very deliberate about providing pricing support for borrowers who are limited by income or by wealth, not bad credit. Now, who are some of these people, that we're looking to provide not only fee reductions, but we've actually delivered fee eliminations to? Well, it's first-time home buyers under certain income thresholds. It's the GSE's flagship affordable mortgage products. That there again, who are these borrowers in those programs? Well, the average credit score for those borrowers were 740 in 2022. These programs target low-income borrowers, but certainly creditworthy.
Mickey Shemi, thank you so much for being with us. We really appreciate it on a busy news day where I know you've got a lot on your plate. Thank you so much, Mickey Shemi of the FHFA. I do want to get to Sonali Basak, who's been monitoring the call. The analyst call has been going on with JP Morgan. Sonali, what have you found?
A few things that are interesting is this idea of a loss-sharing agreement with the FDIC. And then also, remember, Lisa, one big question mark that has been kind of looming is what happens if you start to mark these bonds to market, because they did take the fair value marks when they took this debt on. I know you're a bond person, too. What does this mean in terms of ripple effects, in terms of pricing, is an open question. Now, JP Morgan has also said that no systemic risk exemption was required. That doesn't answer the question of whether it would have even been considered in an instance like this. And I think that leaves open a question about what it means for any future deposit flights when it comes to the banking system. I know we're going to be speaking a little later in the day to Citigroup CEO Jane Fraser. I know we'll pose a question to her as well about, what it means to not have this kind of blanket security over the banking system and what it means for the smaller regional banks in particular. It'll be a very interesting open.
Sonali, just 20 seconds. Do we know whether Citi was one of the ones in the room this weekend bidding on First Republic?
We believe no, but remember, Citigroup is also facing consent orders, which would create some handicaps and able for them to do it. But JP Morgan, from what we understand, is the only one of the big 6 that were in the final bids.
Sonali Basak of Bloomberg, thank you so much for that. And coming up on Bloomberg TV, where Sonali is right now, is Los Angeles. We will be providing you live coverage at the annual Milken Institute Global Conference, interviews with, among many others, Apollo CEO Mark Rowan, Citigroup CEO Jane Fraser, and the former FDIC chair Sheila Bair. Right now in markets, we are seeing basically range-bound, although inflected to the downside, but basically unchanged. Yields higher, though, and this is notable amid a slew of bond sales. We see some dollar strength, although that has reversed, and we see weakness in the oil space. This is Bloomberg.